first of the chapter that we are taking for the marathon revision, just for your feel good, is GST in India. When you talk about GST in India, let's understand DT and IDT. What's the main difference between DT and IDT? Okay, what's the main example of your direct tax? Best example, income tax. Indirect tax, best example, GST as well as your customs. What is the main difference between DT and IDT? Main difference. When you are talking about your direct tax, burden, direct tax, burden shifted or not shifted? Burden cannot be shifted. You have to bear the burden. Indirect tax, burden can be shifted from the manufacturer to the wholesaler, wholesaler to the retailer 1, retailer 1 to retailer 2, and finally to the end consumer. And don't call it as customer, it is end consumer. Who bears the final pain of indirect taxes? It is the end consumer. Now, what are the other differences? Which tax is progressive in nature and which tax is regressive in nature? Direct taxes, progressive in nature. Direct tax happens to be progressive in nature. More the income tax. Lesser the income, lesser the income tax. Whereas your indirect taxes, regressive in nature. Irrespective of your earning capacity, whether you are rich or poor, indirect tax will be the same. If a rich and poor goes to a shop and purchase the same item, indirect tax will be the same. And when you talk about the main point, when you talk about direct tax, it is on what? It is on persons, including artificial persons. And indirect tax happens to be on goods and services. It is on goods and services. And the main indirect tax happens to be goods and service tax. Main, not the only. Main is goods and, which is named as GST Act. Correct? CGST Act, IGST Act, SGST Act, etc. etc. Correct? Now, once you know DT and IDT, you clearly know the features of indirect taxes. Features, the characters of indirect taxes. Indirect taxes on what? Goods and services. Is it an important source of revenue for the government? Very important source of revenue for the government. Now the revenue of indirect tax to the government is more than your direct tax. And fortunately, might be not relevant for you, but now in the new syllabus which is going to come from May 2024, indirect tax marks shiftage in your inter is now 50. It was 40 and 60. Indirect tax was 60. Indirect tax was 40 and direct tax was 60. Now it is 50 and 50. So that is always the indirect taxes actually having a major contribution. They have made it equal, 50 and 50. Now coming back to this point, the coverage of indirect tax is wider or direct tax is wider? Indirect tax has got a wider tax base. I am not talking about the return filers. We are talking about the payers. The taxpayers of GST are more than the taxpayers of income tax. Taxpayers, not the return filers. We are not focusing on the PAN card holders. We are focusing on the taxpayers. Now, in indirect tax, what are the main thing that differentiate indirect tax from direct tax? That is shifting of tax burden from the manufacturer to wholesaler, wholesaler to retailer, and finally to the end consumer. The person who bears the final burden is the end consumer. And as the end consumer is not clearly aware that he is going to contribute the indirect tax, there is no direct pain, no perception of direct pinch. Manufacturer will pay, collect it from the wholesaler. Wholesaler will pay but collect it from the retailer. Retailer will pay but collect it from the consumer. Is finally bearing the burden but is not directly paid to the government. So there is no perception of direct pinch, which is there in your direct tax. It is not there in your indirect tax. And that being the case, it is easy to collect GST rather than to collect income tax. And when you talk about your indirect tax, it is inflationary in nature or regressive in nature or both? It is both. It is inflationary in nature as well as regressive in nature. Both inflationary and what is meant by inflation? If the rate increases, 5% changes to 12, 12% changes to 18. Directly it will impact the price. If it is directly going to impact the price, the end consumer is going to feel the burden more. So initially it is 100 plus 5. If it is changing to 18%, the price will become 100 plus 18. 100 plus? It is reverse also. If at all the rate is 18, tomorrow it is going to be 5. 100 plus 18 will become 100 plus 5. So it is inflationary in nature. Is it regressive in nature? Yes. Understand that when you're talking about regressive in nature, the rate is the same. 100 plus say 5%. But the same amount of indirect tax, 5 rupees, will be collected from the rich as well as from the poor. So it is both inflation in nature. Inflation means change in rate will change the price. Regressive means that let the rate be the same, but the same tax will be paid by the rich and the poor. And the final feature of indirect tax is it promotes social welfare by having a very high rate of tax on sin products, be it your tobacco, be it your liquor. All these items will have a very high rate of tax. Understanding the basics of economics, more the price, lesser the consumption. More the price, lesser the. These are all the features of your indirect tax. What we have seen is direct tax versus indirect tax, then comparing the features of your indirect tax. Now, indirect tax was earlier. What was your indirect tax earlier? Before GST, it was all VAT, CST, excise, service tax, etc., etc. Your different indirect taxes. Main taxes being your VAT, CST on sale, excise duty on manufacture, service tax on your provision of services. There are other small indirect taxes also, entertainment tax, luxury tax, betting, gambling, lottery tax, etc., etc. But these are the main taxes. And finally, when the output was there, you had CGST, SGST, or CGST, UTGST, or IGST. If it is intrastate, CGST plus SGST. If it is within the state, CGST plus UTGST. If it is within the union territory. If it is interstate, IGST. And on certain goods, you will be having compensation cess. Compensation. So it will be C plus S plus compensation cess at times. C plus U plus compensation cess at times. I plus compensation cess at times. Now, what was the entire process of bringing your GST? If I were to summarize your entire process of bringing GST, there were two major steps. In between, there was a small step. One, there was constitutional amendment which was required. And thereafter, there was a GST council which was born, which took up to the second step. And finally, you had the acts in place. Finally, you had the acts in place. This was the entire sequence of bringing your GST. The first step was amending the constitution, and the next step was bringing the act. But who's going to bring the act? It was your GST council. GST council. So that was the entire step. Now, before these steps, there were certain attempts to bring out the GST. Right back in 2004, there was a committee called as Kelkar Task Force, which recommended GST on national basis, fully integrated GST, which never came out. Which means only one GST, which is not the reality. Rather, if you go a bit back, it was in 1999 when the former Prime Minister Atal Bihari Vajpayee said that we are going to bring GST. So it starts, at least in Parliament, the discussion was started on 1999 in Parliament. Does it mean that GST discussion was only started in 1999? No. It happened even before, but not in Parliament. Right, so 1999, former Prime Minister Atal Bihari Vajpayee said that we have to bring GST. Then 2004, Kelkar Task Force was formed to bring out GST, to give recommendation on GST, and it recommended fully integrated GST on national basis. The next of the step was in 2006-07, when the budget was presented. The former Finance Minister former Finance Minister Chidambaram, P. Chidambaram, said that we'll be bringing GST right from 1st of April 2010. So he is telling this in 2006-07 and promising to bring GST on 1st of April 2010. Attempt was made to amend the constitution, but it never happened in reality, which means bill was there, but Constitutional Amendment Act was never there. Therefore, these are only the attempts which were initially made. Then the new government came in, then these major steps started. What were the major steps? First, amend the constitution, then bring the amendment of constitution, followed by passing the act. When you talk about amendment of constitution, your 122nd Constitutional Amendment Bill 2014 was converted to 101 Constitutional Amendment Act 2016. 122nd Constitutional Amendment Bill 2014 was converted to 101 Constitutional Amendment Act 2016. Who was to do that work? It was to be done by whom? Both. You are talking about your Parliament and Legislature of States. Parliament and Legislature of States. When you talk about Parliament, obviously we are talking about your Lok Sabha and Rajya Sabha. Right. So it was tabled in Parliament in December 2014, the moment the new government came in, passed by Lok Sabha in May 2015, Rajya Sabha in August 2016, 50% of the states, legislature of states ratified in September 2016. So this was the sequence. It was tabled in Parliament in December 2014, passed by Lok Sabha in May 2015, Rajya Sabha in August 2016, and 50% of the legislature of states in September 2016. And finally, your 10122nd Constitutional Amendment Bill became 101 Constitutional Amendment Act on 8th of September 2016. 8th of September 2016. It became your Constitutional Amendment Act. First step was done. Your first step was, and immediately within a week's time, which means 12th September 2016, the provisions of GST Council were made and given to the President for his assent. And finally, on 15th of September 2016, 15th of September 2016, your GST Council was there. And it had its first meeting. GST Council was in fact there. So what was the connecting point between the amendment of Constitution bringing the Act? What was the connecting point? Between your amendment of Constitution, and bringing the acts, it was GST Council, because GST Council is the only committee which can bring your act. So what was done? Immediately when your Constitutional Amendment Act 2016 was ready on 8th of September 2016, the first of the work was to make effective its council, GST Council. 12th September 2016, the provisions were ready, and 15th September, the assent was given by the President and GST Council started functioning. So 15th of September 2016 is when GST Council was actually born. It is called as a brain of GST. Without GST Council, nothing can happen in GST. Nothing can happen in your GST without your GST Council. And finally, there were acts. When I am talking about acts, again the role of both your Parliament and legislature of states will come. So the moment we talk about your act, it is both Parliament and legislature of states. What are the acts which are passed by Parliament? What are the acts which are passed by Parliament? CGST Act, IGST Act, UTGST Act, because they don't have any legislature. Then GST Compensation to States Act. CGST Act 2017, IGST Act 2017, UTGST Act 2017, GST Compensation to States Act 2017. And what was done by legislature of states? Respective SGST Act. Respective, Delhi would have passed Delhi SGST Act. Tamil Nadu SGST Act. Maharashtra, and so on. And so on. Are you guys clear with this understanding? So this was the entire scenario when your GST was there. Please understand that the acts were ready in April 2017. All these acts, not main acts, all these central acts were ready right in April 2017. In March 2017, end of March 2017, 29th of March 2017, the bill were placed and they became act on April 2017. 12th April 2017, the acts were ready. Then it was the state's turn to pass the act. Central acts were ready on April 2017. Then the states passed their state. What was the first state to pass the SGST Act? It was Telangana. The first state to pass SGST Act was Telangana, and the last state, Jammu and Kashmir. In effect, your GST started functioning with effect from 1st July 2017. But for your Jammu and Kashmir, it was 8th of July 2017. It had a choice. Initially, it did not. Finally, it became part of GST. 8th July 2000. For the rest of India, it was 1st July 2017 for Jammu and Kashmir, which was state then. Now it is 2 union territories. At that point of time, it was state. It was 8th of July 2017. Right? These are the important events that happened when you are talking about your GST. When these central acts were passed, you need to understand that even rules were ready before GST started. Rules were ready in May 2017. Act was ready in April 2017, Central Act. Rules were ready in May 2017. And simultaneously at the same point of time, states are passing their respective SGST. And the first of the state was Telangana and the last of the state was Jammu and Kashmir. So everything was ready before July 2017. What was the date when GST was effective? 1st July 2017. But for Jammu and Kashmir, 8th of July 2017. So this is the entire set of events. Remember that first is you are amending the constitution, then it is passing the acts. In between, the connecting point was GST Council. And when you look at the definition of GST within your constitution, which is Article 366 12A, it tells that GST is a tax on supply of goods or services or both. But it removes one thing from its ambit, except tax on supply of alcoholic liquor for human consumption. It is kept outside the ambit of GST. It is outside the ambit of GST. We'll be discussing that what tax will be there on alcoholic liquor, but it is as of now understand that it is kept outside the ambit of GST. What is permanently kept outside GST? Alcoholic liquor for human consumption. Alcoholic liquor for permanently. There is something called as temporary removal from GST. That will be the petroleum products. But permanent removal is alcoholic liquor for human consumption. Now, when we are talking about the basics, we have seen what is your DT and IDT, features of indirect taxes, and how your GST was born. Now, the next question, which is an obvious question, why was GST born? We have to address the question, why was GST born? What is the concept of GST and what are the advantages of GST? First, to understand why. Then, after we understand why, the next two things are very obvious. What are the concept of GST, how it works, features of GST, and what are the advantages of GST. Rather, the moment we cover why it was born, these two are automatically discussed. Now, please understand that the major issue when you talk about your earlier indirect taxes was what? You are not getting full credit. You are not getting full credit. The moment you are not getting your full credit, there will be cascading. Just to give you an outline, there were different taxes. Like, you had excise duty on what? Manufacture of goods, which was under the control of whom? Central government. It was covered under entry 84, list 1, schedule 7. When it is in list 1, it is your union list. It is your union list. Yes, there was state excise duty as well, but on a small list of goods. Major list of goods was under union list. Then you had another major indirect tax, service tax. Again, service tax is on what? Provision of services. Under whose control? Central government. It was also there in list 1 of schedule 7 and entries, entry 97, residuary entry. Not a specific entry, a residuary entry. Then you had what? Customs, which is still alive. Which is still alive. Again, with the control of central government. It is on what? Customs duty is on what? Import and export of goods. So the moment I tell it is under the control of central government, list 1, schedule 7, entry 83. Entry 83. Then these are all basically the main central indirect taxes. You're talking about your state indirect taxes now. You had VAT CST. VAT and CST, which is on sale of goods. Local sales, VAT. Interstate sales, CST. Under the control of what? State government. So basically it will be under list 2, schedule 7, entry 54. Please understand that VAT is under list 2, CST is under list 1, but CST is levied by center, collected by, finally the revenue will go to state government. So we are only focusing on the state aspect. Revenue will finally go to state. CST was brought only to settle down the fights between the states. Central government will never have any control over VAT as well as CST. Revenue will finally go to state. VAT levied by state, collected by state. CST levied by center but collected by state. Then you had other small indirect taxes, like for example, you had your entry tax, which was on entry of goods, reverse of sales, purchase on entry of goods. Again, the control is of state government, and again, it is in list 2, schedule 7, entry 52. Then you had something called as your entertainment tax, which is on entertainment. But this time it is special. It was levied and collected by either state government or local authority. They would split the powers between both state government and local authority. But with the moment you talk about state or local authority, the list is list 2, schedule 7, entry 62. These were the major indirect taxes, not all indirect taxes, major indirect taxes before you had GST. If you look at the first three are the examples where the control is of central government. The last 3 are the example where the control is of. Please understand, we are not going in depth and seeing what credit is taken by whom, because that is not relevant. You understand the fact that in your industry there are only 3 types of persons. Who are they? Manufacturer, your service provider, and trader. The difficulty was manufacturer was getting few credits and not few major credits. Manufacturer was getting few credits, he was not getting. Service provider was getting some credit and some credit he was not getting. Trader was not at all getting any credit except what? Except we are not there to discuss in depth that which credit is that. It's not relevant. Understand that manufacturer got major portion of ITC credit. Service provider got good portion of credit, but not major portion. Good portion of your credit. Credit is on your purchases, expenses, or fixed assets. Trader got very less, minor portion of your credit. Input tax credit. Earlier, it was either SENVAT credit, CCR, state, or state input tax credit. SENVAT credit or state input tax credit. The moment I am talking about credit, it is on your purchases. We are only focusing on your purchases. The moment you get the credit, your cost, purchase cost decreases. The moment you get your input tax credit, if you get your credit, it is not added to the cost. If you don't get your credit, be it SENVAT credit or be it state input tax credit, it is added to your cost. If it is added to your cost, your selling price increases. Obviously, there's tax on tax, cascading effect. Even when you are giving the goods to the next person, he is getting for a higher price. So when you don't get your credit, there will be cascading effect. Because if you don't get your credit, it will be added to the cost. Just for a small example, say 100 plus 5. This is the breakup of price plus tax. If you get your credit, your cost is only 100. 5 rupees is not added to the cost. If you don't get your credit, your cost is 105. And if your cost is increasing, there will be cascading effect, because if your cost increases, your selling price will obviously increase, and the next person will also be bearing that effect. Right? So it is called as tax on tax, cascading effect. But if you get your credit, there won't be any cascading effect. This is a net difficulty or net major problem in your old indirect taxes. Let us not go into depth and see what manufacturer was getting, what service provider was getting, and what trader was getting. Which credit they were getting and which credit they were not getting. Just understand that manufacturer was comfortably happy. He was getting major portion of credit. Service provider was getting good amount of credit, but not the major portion. Trader was getting minimum credit. Only VAT credit he was getting. Understand, in all the 3, they were not getting some credit or major credit. Every person was having some problem. Manufacturer, lesser problem. Trader, major problem. So the problem was credit. Credit is always on what? On your purchases, expenses, or capital goods. And we have seen the impact. If at all you don't get your credit, your cost increases, there will be cascading effect. Now what happened after GST? All 3 of them, be it manufacturer, be it Service provider, be it trader, they get all the credit. Now there are only two types of purchases. One is intra-state purchase, where there will be CGST plus SGST. One is interstate purchase, where there will be IGST. Obviously, at times it will be along with compensation cess. So when you talk about your intra-state purchases and interstate purchases, you be a manufacturer of goods or your service provider or your trader, don't worry. You need not worry about any of these aspects. Why? Why? You will be getting all the credits. You will be getting all the credits. So there is no need to worry. There is no need to worry about credit. When I tell all the credits, understand that there is something called a section 17(5) of your CGST Act, where there is a block credit. Correct? So it is not that cascading effect is fully removed. But yes, majorly it is removed. And the good thing is, there is no partiality between manufacturer, service provider and trader. Majorly they will get all the credits. If it is not allowed, it is not allowed for anyone. If it is block credit, it is not allowed for anyone. So this was a major turning point. Rather, you can tell that the main reason was GST was brought was your cascading effect, to remove the cascading effect. So what was the main problem in your old indirect taxes? What was the major issue in your old indirect taxes? Major issue in your old indirect taxes. Cascading effect of taxes. Cascading. Now, what is the advantage of GST? No cascading. Now we are seeing simultaneously even the advantages. Earlier, there was cascading. After GST, there is no cascading. Earlier, you had double taxation. On certain sectors, software, restaurant and construction, you had double taxation, both VAT as well as CST. At that time, both VAT as well as service tax. VAT on goods portion, service tax on service portion. And there were multiple taxes also. Like we have discussed, there are various number of taxes. Double taxation is on the same item, two taxes. Multiple taxation means you had different names of taxes. You had entry tax, you had entertainment tax, you had octroi duty, you had even stamp duty, which still continues. You had customs duty, you had excise, you had VAT, you had CST, etc., etc. It goes on, the list goes on. Now it is only GST. And now these two issues are no more there. Why? There is elimination of multiple taxes as well as there is elimination of double taxation. These are the problems in your old indirect taxes, but in your GST, there is no double taxation. And most of the multiple taxes are formed into one GST. Yes, there are still other taxes, but major indirect taxes are now clubbed into GST. Now, earlier, if you are purchasing from other state, there was CST. If you are purchasing from other state, there was, you will not get the credit. You will not get the, whether you are manufacturer, service provider or trader, you will not get the credit. CST credit is not got by anyone. You don't get the credit of CST, Central Sales Tax. Be a manufacturer, be a service provider, be a trader. Right. Now, supposing I am in Tamil Nadu, I purchase from Maharashtra. It will be CST. I will not get the credit. Same situation after GST. I am in Tamil Nadu, I am purchasing from Maharashtra. What will be the tax? What will be the tax? Will I get the credit? Yes, I will get the credit. Now, there is one nation. There is one nation, one market. One nation, one market. I purchase from Tamil Nadu, within Tamil Nadu, or from outside Tamil Nadu. If it is within Tamil Nadu, CGST, SGST, I'll get the credit. If it is from outside Tamil Nadu, IGST, I'll get the credit. So I don't have that difficulty. I don't have that. These are all the issues, and this is the solution. Obviously, there were other issues, overlapping in valuation. Not only double taxation, overlapping in valuation. Valuation. When we talk about VAT, VAT was on selling price plus excise duty. I'm not talking about double taxation. It was overlapping of valuation. So where a manufacturer will pay two taxes, excise duty plus VAT. That is no problem. It's not double taxation. That's no problem because he is doing two events, manufacturing and selling. But when he is paying VAT, he was paying on price plus excise duty. Don't worry, it still continues in GST. So on certain items, to be very specific, when you're talking about your GST, tobacco, you'll have excise duty plus GST. GST is also on price plus. So you don't find any advantages given here. This problem still is there in your GST, and local taxes are not included in your credit chain. Your local taxes which are there, you don't get any credit. So if it was entertainment tax, luxury tax, you don't get the credit. But this problem is addressed. How this problem is addressed? Because now there is no cascading effect. You will get all the credit. There are no local taxes. When there are no such local taxes, this issue by default is addressed. Earlier, local taxes like your betting, gambling, lottery tax or luxury tax or entertainment tax, if you have expenses on these ambit, supposing you're talking about a company which is having all these taxes, when you book a hotel room, that's luxury tax, which is for business purposes, but you don't get the credit. But now in GST, if you book a hotel room, there'll be GST. No need to worry, you'll get the credit. You'll get the credit. So this issue is also addressed. So these were the issues in your old indirect taxes. There was cascading effect in GST, no cascading effect. Double taxation, multiple taxation in GST, no double taxation, no multiple taxation. Then it was one state, one market. One state in GST, one nation, one market. One nation. So you're talking about the issues in old indirect taxes versus advantages of GST. Now, as we have started with advantages and we have seen the first three advantages, what are the other incidental advantages? It will also boost your Make in India initiative. Why? Foreign companies will now be readily investing in India because they are very well aware of the concept of GST. Reason being, more than 80-85% of the countries in the world already have adopted. So they are already aware. So they are happy with GST because they don't have any fear of taxation in India. So they'll be investing in India, rather booming, making your Make in India initiative more prosperous, which has happened. In fact, initially it was not so clear. After a lot of years, now you see this Make in India initiative working out in reality to the extent that even our defense, we were dependent on outside India. Now we are self-dependent. We are not anymore dependent on other countries. We are independent, right? So that is the impact of your Make in India initiative. Even we take any sector, you'll get lots of examples, be it automobile sector or your mobile phone. You'll find a lot of examples where after this Make in India initiative has started, simultaneously clubbing with your GST, the result is that. And finally, government was very clear. This result is also now very clear. Initially, government was not sure whether we'll have high revenue or not. State government were much afraid whether we'll have high revenue or not. Every month, read the newspaper, right? Maybe around 7th to 15th, you'll get a newspaper article that comparatively the GST revenue versus the earlier month. This is the increase even after COVID. Yes, there was an impact of COVID for 1.5 years, but thereafter you have seen the effect, increase in government. These are all incidental advantages. These are all direct advantages. The first three advantages that we have seen, they were all direct advantages. You could see them at the time when GST was brought. You can actually see them. But these advantages, it took time. Now you're seeing the results. It took time. Initially, if at all I was talking this in 2017, 2018, 2019, it was difficult to understand. But now, in 2023, it's very easy to understand that yes, this is the clear-cut advantages, incidental advantages, not direct advantages. These are all incidental advantages, right? So we have seen the issues in old indirect taxes versus advantages in GST. Now let us even focus on your concept of GST. Obviously, this is also completed when we have covered all these points. GST, like other indirect taxes, is also a value added tax. It is only on validation. We have the concept of input tax credit, then output tax. So obviously it is value added tax. There is a continuous chain of credit. Manufacturer will pay output tax, wholesale will get the input tax credit. Wholesale will pay output tax, retailer 1 will get the input tax credit. Retailer 1 will pay output tax, retailer 2 will get the input tax credit. Retailer 2 will pay output tax, but the end consumer will not get the credit. The final burden is borne by the end consumer. Is there cascading or no cascading? There is no cascading. you get all the credit. So there's no cascading. And moreover, we have to understand that in GST, we have differentiation between goods and services, but obvious. Goods is different, services is different. But for both the definition of goods and services, you have to refer the same act. Unlike the earlier indirect taxation where you have to refer for the meaning of goods, separate act, meaning of services, separate act. You are going to refer the same act, CGST Act 2017. Right. These are the concepts of your GST. How it works. Features of GST. So once you understand the problem in old indirect taxes and advantages of GST, you know how it works. Features of your GST. It is a value added tax, that's full credit, therefore there's no cascading, but the end consumer will not get the credit. And in GST, goods and services are different, but you can refer the same CGST Act to understand what is goods and what is service. Right. So this is all about your issues in old indirect taxes, advantages of GST, and also the concept of GST. Now, let us go to the constitutional provisions and just understand on the outer side what are the constitutional provisions with respect to your GST. Now, when you talk about your constitutional provisions, because we need to understand when GST was born, the first of the step was amendment of constitution. What was the first step? Amendment of constitution. So what was the first? Here to understand a bit of constitution. There's an article 265 which tells that if at all you want to bring any tax in India, there should be a law. Article 265. If you want to levy and collect any tax, please have a law. Then Article 245 tells that, okay, for a tax, there should be law. Who will bring the law? Either Parliament or State Legislative Assembly. If it is for whole of India or part of India, Parliament. If it is for the whole of the state or part of the state, it is State Legislative Assembly. For a tax to be there in India, that should be law. Article 265. Who is going to bring the law? Parliament or State Legislative Assembly. Article 245. Which law by Parliament? Which law by State Legislative Assembly? This was decided by Article 246 read along with Schedule 7. You are under the control of Parliament, Union List, List 1. You are under the control of State Legislative Assembly, List 2, State List. Few are under Parliament, few of them are controlled both by Parliament and State Legislative Assembly, List 3, concurrent list. There are tax laws in List 1 and List 2, but in List 3 there are no tax laws. There are no tax laws. These items automatically you will understand when we see the further discussion which are the tax laws which are still there in List 1 and List 2. Automatically you will understand. We are not going to focus now. Now, List 3 was an ideal place for GST to be there. Because both there is the control of Parliament and State Legislative Assembly. So initially if you see the committee meetings report, you will find that they thought that they will bring GST in List 3. But finally it did not happen. Why? List 3 is having a problem. It is as of till GST was born, there was no tax laws in List 3. Even after GST was born, there is no tax law in GST. What is the major problem in List 3? Though it tells that both Parliament and State Legislative Assembly will decide together, but there is an article called as Article 254, which tells that Parliament will have supremacy. So if any conflict is there, who will have the final decision? So states will not agree. States will not. That being the case, how GST was born? GST was not kept inside Article 246 List 3. It was born by way of a new article called as Article 246A. 246A. So birth article of GST is Article 246A, by which you had your CGST Act, by which you had your SGST Act, by which you had your CGST Act, by which you had your obviously UTGST Act also was born because union territories don't have their own legislative assembly and Parliament did make them. Right, CGST Act by Parliament and UTGST Act by Parliament, SGST Act by State Legislative Assembly. Article 246A. But then there is a exception which tells that few matters, very few matters, rather to be very specific, 2 matters will be decided only and only by Parliament. Will be decided only and only by, and that gives birth to your IGST Act. The reason for the birth of IGST Act 269A. What are the two matters that will be decided only by your parliament? Whether it is an interstate supply or intrastate supply. Whether it is an interstate supply or intrastate supply. How to find interstate supply or intrastate supply? You have to find out place of supply. You have to find out place of supply. Only parliament will decide whether it is interstate supply or intrastate supply. Right. So when you're talking about your place of supply provisions, you're talking about your place of supply provisions. So be very specific. Section 10, Section 11, Section 12, Section 13 of your IGST Act. Obviously read along with Section 7, 8, 9 to help out, to find out inter or intra. Place of supply is by 10, 11, 12, 13. To find out interstate supply, intrastate supply, after finding out place of supply is 7, 8, 9. It is parliament. And these sections are of IGST Act. And there it is very clear that if it is import of goods and services, by default it will be interstate supply, IGST. So that's a clarification. Import and export is always interstate, IGST. So that is the first subject matter. Second subject matter. When you talk about your intrastate supply, CGST, SGST. CGST revenue by parliament and SGST by legislature of state. But what if it is IGST? IGST does not belong to center. It will collect and retain 50% it will have, balance 50% it will distribute to the consuming states. GST is a destination based consumption tax. Don't forget, GST is a destination based consumption tax. It will give to the destination state. Who will decide what was the destination state? It is not a single transactions. Crores and crores of transactions will happen in a single day. How to decide that? Parliament will have on the portal, they take the help of the portal, they get the statistics from the portal and thereafter they'll do the calculation and distribute. Now that is decided by whom? That is decided by whom? Parliament. So if at all you're talking about your GST on interstate supply, it will be levied and collected by center. It will have it, but finally a portion between union and states. Finally it will be distributed between union and states. Union and states. Are you guys clear with this understanding? So this is also discussed in your IGST Act. Are you guys clear? So basically what is the birth article? 246A. Be it your CGST Act, UTGST Act by Parliament, SGST Act by respective state. But few matters are to be decided only and only by Parliament. They are to be decided only and only by Parliament. That is IGST Act. What are the two matters? IGST Act will talk only about these two issues. Place of supply to decide intrastate supply, interstate supply. And if it is IGST, how to apportion IGST revenue between union and the states. Only these two matters. You will not find anything extra in your IGST Act. Are you guys clear with this understanding? 246A, 269A. Then, what is the brain of GST? Or the godfather of GST? Godfather of GST happens to be your GST Council, the provisions of which are discussed in Article 279A. Article 279A. And when you talk about the members of GST Council, there will be two members of the center, that is Union Finance Minister, who has visited our city recently, and Union Minister of State in charge of Revenue or Finance. Right, two members of center. And 31 states. How many states are there? Totally 28 plus 3 union territories. DPJ. APJ Abdul Kalam, replace it by DPJ. Delhi, Puducherry and Jammu Union Territory. Not Ladakh. Jammu Union Territory. They will be treated as states. They will be treated as states for the purpose of GST. For the purpose of GST. So in total there are 31 states. Now there will be 31 representative of the states. Basically the state finance minister or the nominees will be coming there in the meeting. Who will be the chairperson? Union finance minister. Vice chairperson they will choose among themselves. Chairperson is always Union finance minister. VC will be selected by the members. Now what is the purpose of GST Council? Rather, you can understand that what are the taxes which will come inside GST is decided by GST Council. Rates, exemption threshold for registration composition is decided by GST Council. The model GST law, apportionment of IGST among the union and the states, place of supply is decided by GST Council. Petroleum products which are kept outside now, when they have to be brought inside GST by GST Council. Special rates for special period, like for example, Kerala had got Kerala cess at the time of calamity, decided by GST Council. Special provisions for special category states, will be seeing them in your registration. Right? You have Tripura, Manipur, Mizoram and Nagaland. They have special limits decided by GST Council. If at all two states are fighting, who will be resolving the dispute? GST Council. Not only two states, center and state fighting for the revenue, which will happen very soon, which you have not seen till now, but which will happen very soon. That also will be first decided by GST Council. But I am very sure that GST Council will not find a solution. That will go to court. That will go to the court. Finally, any other matter. Don't spend your time. Anything, everything in GST is decided by GST Council. Anything, everything in GST is decided by anything that is to happen in GST. When there is an amendment in GST, make very clear that there was a GST Council meeting after which they proposed something and it was finalized. There will be something on agenda. Say 10 items on the agenda, 8 items being finalized. Out of 8 items, you will get amendments in 7 items. It is not necessary that all the 8 items which are finalized by GST Council will see the amendments. So if you see the history of GST Council meeting, 10 items on agenda, 8 items being passed. Don't have a misconception that all 8 items will convert into amendments. We have seen cases where out of 8 items which have been passed by GST Council, only 7 have converted to the provisions of the Act or the rules. Few of them, though they have been finalized by GST Council, they are yet to see the light of the day. Right, that will happen. But one thing is very clear. Anything and everything in GST will come through GST Council. Now, when GST Council is deciding, 2 important things you should see. First, see the quorum. See the quorum. And once quorum is there, see the pass percentage. See the pass percentage. This is to be done for each of the item in the agenda. 10 items on the agenda, quorum will be decided only once, not for each of the item. But for pass percentage, it will be seen for each of the item. What is the quorum? How many members are there in totally? 2 plus 31, 33. 2 plus. So, first thing, when the meeting is starting, what is to be checked? What is to be checked? 50%. Check it only once. See whether 17 members are present. See whether 17 members are present. If 17 members are present, only then meeting can start. Only then, if 17 members are not present, forget about the second step. And this first step will be seen only once when the meeting is started. Second step will be seen for each of the item. Will be seen for each of the item on the agenda. What is the pass percentage? What is the pass percentage? 75% is the pass percentage. 75% is the pass percentage. But that 75% is the weighted average pass percentage. And that is only of members present and voting, not of the total members. Members present and voting. 75% first special point. It is not simple average, it is weighted average. Second special point. Don't calculate all the members. It is present and voting. Present and voting. Put in a simple way. What will be the formula? What is the weightage? The weightage of the center is given as 1/3 and weightage of state is, all the states put together is given as. So what will be the formula? So we'll just see the formula so that you understand how to calculate the pass percentage. So 1/3 weight is given to the center. See how many of them are in favor. How many of them are in favor, and see how many of them are present and voting. This will be for center. This will be for your center, which means you're basically talking about your 3 members. 1/3 multiplied by who are in favor. This will be decided for each of the matter. Who are in favor divided by how many members of center are present and voting. Don't even include state. Then 2/3 of how many members of states are in favor. Now don't see center, only focus on the states. Divided by total members of the state present and voting. You'll get a percentage. If it is 75% or more, superb. That item on the agenda is passed. If it is less than 75%, that particular item on the agenda is not passed. This is not in totality for the entire meeting. This is for each of the quorum is checked only once. But this pass percentage is checked for each of the item on the agenda. Are you clear with this understanding? This is how you have to calculate your weighted average. For center, 1 divided by 3 multiplied by center members in favor of that item which is being discussed divided by total members of the center present and voting. I am not writing divided by 3. Out of say 3 members, when you're talking about total members of the center, how many members are there totally? 2. Out of 2 members, might be only 1 is present. Generally, it doesn't happen, but might be only 1 is present. So, this favor divided by number of members of the center present and voting. Understand this with states. States is 2/3 multiplied by members of the states in favor divided by states present and voting. Totally, out of 31 states, present and voting might be only 20. In favor might be only 15. So, 15 divided by 20. 15 divided by 20. Right, this is how you have to see the pass percentage. GST Council. And the main thing that is required and which can be tested in your MCQ is this GST Council pass percentage. See, MCQ you cannot finally see on the question paper what MCQs were asked. But finally, when you understand the way IC have started asking MCQ for the last 3 years, they are asking very typical MCQs so that you have to know the provisions fully. MCQs are more challenging than the other questions. So they'll be asking these questions, and when you see the case studies, you'll understand that they have started linking the chapters from 4 to 5 chapters which you have been doing in the class. Right? Initial period of your GSC, linking of chapters was not so much. When you see your MCQ, the first case study questions, you understand why it was very important to connect the different chapters, why it was very important for us to switch over the chapters. In class, many of you would have felt that this chapter linking with this chapter, again going back to this chapter, again going, it is required. Taxation is a subject which has to be interlinked. GST Council, this happens to be a very important point. And finally, when you're talking about the last part of this subject, this particular chapter, again an important thing. So when you're talking about from your exam point of view, maybe GST Council, the calculation might be very important, and this last area is very, 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 very important. When you're talking about your GST, what are the taxes that have been subsumed inside your GST? Which means that have been merged inside GST, they are no more that they are dead. So let us understand what are the central taxes which are subsumed inside your GST, state taxes which are subsumed inside your GST. Very quickly, I want from you, what are the central taxes that are subsumed inside GST? First one, excise duty. Excise duty, be it central excise duty or be it additional excise duty or be it excise duty on medicinal and toilet preparation. Excise duty. Second, your service tax. Third, you're talking about your CST. CST is levied by center but collected by, therefore you find in the central list, CST. Right. Customs duty, whether it is subsumed inside GST. Whether customs duty is alive or dead. Customs duty is still alive. Customs duty was earlier basic customs duty. Then you had CVD, which was nothing but duplicate of excise duty. Then you had education cess and secondary education cess. Finally, you had special CVD, which is countervailing or counterbalancing of VAT. After GST, customs duty is still alive. Right. And your education cess, secondary education cess has become social welfare surcharge. That is not because of GST. Over a period of time, the new government will always try to bring something new. So they brought out social welfare surcharge. And finally, when you're talking about your CVD and special CVD, they have merged into your IGST. They have merged into your, so CVD and special CVD is no more there. It is merged into your IGST. Very simple reason. When excise is dead, duplicate of excise cannot be there. When VAT is dead, duplicate of VAT cannot be there. They are replaced by IGST. So customs duty today is BCD plus SWS plus IGST. So what portion of customs is gone? Customs is not gone, but what portion of customs is gone? Which portion of customs is gone? CVD and special CVD of custom portion is gone. It is merged into IGST. Customs duty is alive, but the breakup of customs duty is BCD plus SWS plus IGST. CVD and special CVD, that is countervailing of excise and countervailing of VAT, is no more that. These are the central taxes which are gone, dead. What are the state taxes which are gone? You have your VAT and sales tax being gone. Opposite of that is entry tax, that is also gone. Then you have your taxes on your advertisements, betting, gambling, lottery tax, that is gone. That is gone. Then you have your luxury tax, which is gone. But when you talk about your entertainment tax by state government is gone. Whereas your entertainment tax, which is by your local authority, is still alive. Entertainment tax by state government, gone. By local authority, alive. So what are the state taxes which are gone? VAT, entry tax. Advertisement, betting, gambling, lottery tax. Luxury tax, gone. Entertainment tax by state government is gone. But entertainment tax by local authority or local body is still alive. Still, why I am not touching the last points here is it is talking about cess and surcharges. If at all the main taxes are gone, obviously the cess and the surcharge on them is automatically gone. These are all the taxes that have subsumed inside GST. These are the only taxes. Are there other indirect taxes which are still alive? Yes. Please come over the myth that all the indirect taxes have gone. There are other indirect taxes which are still alive. A few examples of that. When you talk about your central taxes, your air travel tax, still alive. Your air travel tax is still alive. Pollution tax, still. Clean energy tax, we call it as clean energy tax, still alive. State taxes, your road tax, still alive. Motor vehicle tax, still alive. Stamp duty, still alive. So don't have a myth that all the indirect taxes are gone. These are the specific list of indirect taxes that have gone. If you don't find that item in this list, it means it is still alive. Once you know these items, the special goods which are very important, which are having different tax. Special goods. Now I said that excise duty is gone, VAT CST is gone. It is gone, but it is there on certain items even now. What are the special items that are there? Your alcoholic liquor for human consumption, your 5 notified petroleum products which are petroleum, crude, high-speed diesel oil, motor spirit which is commonly called as petrol, natural gas, and aviation turbine fuel which is called as white petrol. Not any petroleum products, 5 notified petroleum products. Then you have tobacco and tobacco products. Then you have your opium, Indian hemp and narcotics. Opium, Indian hemp and narcotics. These special items are having what? They are having different taxes. Alcoholic liquor for human consumption, not normal alcohol. Alcoholic liquor for human consumption. Outside GST or inside GST? Outside GST. Permanently outside GST. Permanently outside GST. What is the type of tax? State excise duty, state VAT. That is a negotiation between the center and the state. States were given this permanently. State excise duty plus state VAT. CST is also going to the state only. Levied by center but collected by state. State excise duty and state VAT. Both will go to state government. Both excise duty revenue will go to state government as well as VAT revenue will go to state government. What about tobacco? What about 5 notified petroleum products? Not any petroleum products, 5 notified petroleum products. They are temporarily outside GST. Time being they are outside GST. GST council will tell when they will come inside GST. What are the taxes on them? Central excise duty which will go to central government only. VAT CST which will go to state government only. Just see the difference. When you talk about alcoholic liquor for human consumption, permanently outside GST. Constitution amendment is required to bring inside GST. And the taxes on them is state excise and state VAT. Both will go to state government. 5 notified petroleum products. Timing they are outside GST. Who will tell when to come? When they will come inside GST? GST council. And what are the taxes? Central excise duty fully going to central government, and VAT, which will fully go to state government. Then you have tobacco. See, understand, tobacco attracts GST. Even your opium, Indian hemp, narcotics attracts GST. So these items, please make it very clear, they attract GST. They attract GST. They do attract GST. But the differences. What are the difference? When you talk about your tobacco, it will be central excise duty plus GST. Central excise duty fully will go to the central government. GST will be shared between center and the state. Plus GST. GST will be on price plus excise. Price plus excise. Likewise, state said that, okay, if you are taking such item, let us have one item for ourselves. What is that? Opium, Indian hemp, and narcotics. What is the item? What is the tax? State excise duty plus GST. Plus state excise duty fully will go to the state government. GST will be shared between center and state. And when it's GST, it will be on price plus excise. Price plus excise. And compensation cess will be there on select items. Initially, for the initial few years, please understand that this is not 5 years, it has been extended, maybe 6.5 years or 7 years approximately. But the central government has said that we will give you the entire revenue of compensation cess. Entire revenue of compensation cess. Entire revenue. Because you have a fear of loss of revenue. So what we'll do, whatever compensation cess we are collecting on certain items, not on all items, we will give it to you fully. We will give it to you. Thereafter it will be fully belonging to the central government. But initially, for the initial 6.75 or 7 years, it will be fully given to the states, fully distributed to the states. Initially it was 5 years, then it was extended. Are you guys clear with this negotiation part? And the final part of this chapter is this was a very important discussion. What are the taxes which are inside GST, outside GST, and what are the special items which attracts different types of taxes? 4 special items attracting different types of taxes. And finally, when we talk about your GST, GST is a destination based consumption tax. Destination based consumption tax. Finally, revenue will go to the consuming state, not the manufacturing state. Not the manufacturing state. And how to understand when it is CGST, SGST, when it is IGST? If I tell the goods are coming from USA to say Maharashtra, Maharashtra to say Tamil Nadu, Tamil Nadu to say Lakshadweep, Lakshadweep back to USA. If it is one country to another country, IGST. If it is goods, BCD, SWS plus IGST, custom duty. If it is service, IGST. If it is service, it is goods, it is custom duty. BCD, SWS, it is not GST. It is custom duty, BCD, SWS, IGST. If it is service, only IGST. Then if it is within the state, if it is moving from Maharashtra to Maharashtra, CGST plus Maharashtra SGST. From Maharashtra to Tamil Nadu, one state to another state, IGST. From Tamil Nadu to Tamil Nadu, CGST, SGST. From Tamil Nadu to Lakshadweep, IGST. Within Lakshadweep, CGST plus UTGST. Lakshadweep back to USA. Simple. If it is within the same state or within the same union territory, it is CGST plus SGST or CGST plus UTGST as the case may be. But if it is from one state, another state, one union territory, another union territory, state to union territory to state, one country, India, outside India, it is all IGST. It is all IGST. Right? One exception. Even if it is within the same state or same union territory, even if it is the same state or same union territory, assume that it is within the same state. You are talking about sale from domestic tariff area to special economic zone, or from special economic zone to domestic tariff area, right? All are there in same state, Tamil Nadu. Though they are there in Tamil Nadu, what will happen? what will happen? This will always be treated as IGST transaction. When it is zero rating, when it is not, forget about, but it is treated as IGST. It is treated as IGST. Right. So that is an exception which is there when you talk about CGST, SGST or IGST. Understand that by default it is IGST. CGST, SGST, it should be within the same state or within the same unit entity, and that also it should not have, the transaction should not be having special economic zone. The transaction should not be involving special economic zone. So that is where you talk about your intra-state supply and interstate supply, and that being the case, our Indian GST model is called as dual model. Intra-state model, interstate model. Intra-state model, interstate model. Dual model of your GST. Right. So that completes our basic concept of introduction of your GST. The items which were not touched, automatically they are covered when we have discussed the different points. Automatically. So the uncovered portion, the moment you have discussed other areas, automatically they have been covered. Introduction to your GST. Let's start with the second chapter, which is the basic chapter, levy, foundation for GST, levy of GST. The provisions that we will be discussing basically revolves around your CGST Act. Needless to say, unless otherwise I mention a provision of IGST Act. So whenever a section is addressed, it is of CGST Act. And section 1 both of CGST Act and IGST Act tells that it extends to whole of India, including the state of Jammu and Kashmir. Now it is not state, it is to union territories. It is applicable to the union territories in Jammu and Kashmir, which means there are two union territories, Jammu and Ladakh. It is applicable even for them. Now when you talk about your levy, what are the charging section in your CGST Act? Charging section in your CGST Act happens to be section 9, and correspondingly in your IGST Act it is section 5. Section 5. Our focus is only on section 9.1. Section 9.1. 9.2 we have already completed. 9.252 we have already completed. 5 notified petroleum products, as of now they are not inside GST. They will be inside GST when GST Council recommends, followed by the notification by the government. So as of now they are not inside GST. So entire focus is on section 9.1 read along with section 5.1. Even 9.3, 9.4, 9.5, when you're talking about that, they are talking about your RCM type 1, RCM type 2 and electronic commerce operator, where supplier is not responsible to pay the tax to the government. Who's responsible? Either the recipient or a third person in section 9.5 is responsible to pay the tax to the government. It's not FC. Normally by default it is forward charge mechanism. Supplier will collect tax from the recipient. Burden is shifted, but he will pay tax to the government. If he is not paying tax, government will give notice to the supplier, not the recipient. Forward charge mechanism. So we are not touching. The second area is already completed. 9.2, 9.3, 9.4, 9.5 is to be discussed in another chapter. Now the entire focus is on section 9.1, where you are talking about 6 P's. We are talking about your 6 P's. Product, process and place, first 3 P's. Price, percentage and person, next 3 P's. What are the product for your GST? The product for your GST is your goods and services, except alcoholic liquor for human consumption, which is permanently kept outside, which we have already discussed. So goods and services. Product is goods and services. Your process is supply. Your process is supply. The essential taxable event in GST is supply. If there is a supply, that's GST. If there's no supply, there's no GST. Taxable event is supply. And your place. If it is CGST, HGST, intrastate. If it is IGST, if you see the same thing in your section 5 of your IGST Act, you will find interstate. CGST and SGST Act, you will find intrastate. IGST Act, you will find interstate. IGST Act, you will find interstate. Product, process and place. Product is goods and services. Processes, supply. Places, intrastate for CGST Act and SGST Act, interstate for IGST Act. Now when you talk about the next 3 P's, price is nothing but your Valuation as per your section 15, an important area in your GSE, 100% short question when you're talking about your exam paper. Valuation under section 15. Percentage. Next piece, percentage. What are the normal percentage that you have in your GSE? 0, 5, 12, 18, 28. Special rates are there, right? Starting from 0.25 percentage, 3 percentage, 0.1 percentage, even other percentages are there. Special rates are there. Don't think that these are the only rates. Special percentages are there. That's something called as abatement by which you'll have a special percentage. Normal rates are 0, 5, 12, 18, 28. That doesn't mean that these are only 5 rates. There are special rates. For example, 0.1, 0.25, 3, etc., etc., etc. Special rates are there. Right. Now, what is the maximum percentage that you can have in your CGST Act? 20% maximum. When you are talking about, say, the rate being 12%, it is 6 CGST 6, SGST and IGST 12. So by that angle you have to remember. When you are talking about 28%, IGST it is 14%, CGST 14%, SGST and IGST is 28. So maximum percentage that you can have of CGST, max CGST 20, SGST, whereas IGST you can have 40. IGST you can have 40 percentage. And finally, you're talking about the person. Who's the person who has to pay tax to the government? Taxable person. Normally, that taxable person happens to be the supplier. Forward charge mechanism. Normally, it is a supplier. Supplier will collect tax from the recipient. He can shift the burden. But who's responsible to pay to the government? Supplier. He has to pay to the government normally. Are there exceptions? Yes. Where your recipient or third person will be asked to pay tax. That is covered in your section 9.3, 9.4 and 9.5. Normally who's responsible? Supplier. Normally who's responsible? Supplier. Taxable person. Taxable person. Right. So when you talk about your levy, the focus is on first 3 P's, then the next 3 P's. First 3 P's are to make sure that tax is there. When tax is there, to calculate tax, you require price and percentage. And when you calculate tax, you require a person to pay it. You require a person to pay it, which is a taxable person. Which is who is going to pay? It is a taxable person who is going to pay the tax to the government. In this chapter, our focus is on the first 3 P's. Product, process and place. By the way, place we have covered when you discuss your intrastate and interstate. Intrastate and interstate. Now, the moment you have seen section 9 of your IGST Act, simultaneously section 9 of your CGST Act, simultaneously section 5 of your IGST Act gets covered, except for the fact that when you talk about your import of goods, which will attract customs, the breakup of which is BCD, SWS and IGST. Breakup of which is BCD, SWS and IGST. For IGST calculation, both the value and the rate, that you have to refer to the Customs Act and Customs Tariff Act. Because basically you are covered by Customs Act. So your reference point will be always Customs Act. To find out the value for IGST portion of customs duty, refer Customs Law. Even to find out the rate, refer Customs Law. Customs Law will again refer back to GST law. Right. So for IGST portion of your customs duty, there is an interconnection between Customs Act and GST law. Customs law and GST law. So why this is there only in IGST Act? Why not there in CGST Act? Simple reason, when you talk about your import, it is always interstate. So this provision will be there only in your IGST Act. Correspondingly, it will not be there in your CGST or SGST Act. Right. So that is the basic understanding of your provision of section 9 of CGST Act and section 5 of your IGST Act. Now, what are the 3 P's that you are going to touch here? Product, process and place. Before we touch the product, process and place, you need to understand India per se, because you have to understand that there will be CGST, SGST and there will be IGST. At times there will be even CGST and UTGST. What is the coverage? CGST and SGST are applicable to entire India, including the state of Jammu and Kashmir. Now there are two union territories there. What is India? India landmass is normally that you think of the geographical location, including Jammu and Kashmir. Sea area. Forget about everything else. Remember that sea area is extended up to exclusive economic zone. Sea area is extended up to exclusive economic zone. That is 200 nautical miles. It is not territorial waters of India, 12 nautical miles. It is not even contiguous zone of India, 24 nautical miles. It is up to 200 nautical miles. Territorial waters of India will always be sovereign part of India. But when it comes to economic collection, economic rights, GST being a law where you are going to collect tax, it will be extended till EZ, exclusive economic zone, 200 nautical miles. And the air area is above the landmass and territorial waters of India. So land area is only above the territory and the territorial waters of India, not up to EZ, only above the landmass and TWA. Sea area only above T area. This basically is required when you're talking about your satellites. Classic example now you can have a successful mission, Chandrayaan 3. So that is only when you're talking about the tax collection. With obviously when you talk about all these satellites, they generate a lot of revenue. Not all satellites, but they generate a lot of revenues. Obviously, when revenue is involved, that's a question of taxation. So that is the intention of the air area. Landmass, everything including Jammu and Kashmir. Sea area up to 200 nautical miles. Air area above the territory and above territorial waters of India. State and union territory, by the way, we have already covered. States. How many states are there? 28. But for GST it is 31. Delhi, Puducherry and Jammu and Kashmir. They will be treated as states for the purpose of how many total union territories are there? Not 7. It is 8. It is 8. But for the purpose of GST it is 5. Remove these 3. What are the 5? Andaman, Nicobar, Lakshadweep, Dadar and Nagar Haveli and Daman and Diu. Earlier they were 2, but now they are merged into 1. Ladakh, Chandigarh. So then what is this other area? Pray that this will be a reality soon. If India acquires a part of Pakistan and part of China, till the time it is recognized as a state, it will be called as union territory. It will be called as, this happened with Hyderabad, this happened with Goa, right? So a lot of states that you see as states today, they were not states initially. So when you talk about these areas, till the time it is recognized as a state, it will be called as union territory. So any territory which is acquired by India, initially it will always be treated as union territory. Right. So that is the meaning of India, state and union territory for the purpose of your GST law. Now, focusing on the 3 P's, product, process and place. We are focusing on the 3 P's, product, process and, by the way, when you talk about product, process and place portion we have already completed. Why? So when you talk about your place portion, it talks about your intrastate and interstate, which you already discussed. In dual model of GST, you have discussed when it is intrastate and when it is interstate. Now let us focus on your product, goods and services. What do you mean by goods and what do you mean by services? Goods, main portion. When you talk about goods, all the definitions that we are going to see is under section 2 of your CGST. You need not remember the clause section 2. So when you talk about your section 2, clause 52, it talks about goods, clause 102 talks about services. So when you talk about goods means movable property, service, anything other than goods, movable, service, anything other than goods. Both goods and service will not include money and securities. Mere transaction in money, mere transaction in security will neither be goods nor be services. No GST. Any transaction that you have only with money or only with securities, you will not have GST. I'm not talking about the corresponding charges. I'm talking about the mere transaction in money, mere transaction in securities. Neither goods nor services, no GST. Now, goods means movable minus money and securities plus actionable claim, growing crops and grass or things which are attached to or forming part of the land which are agreed to be severed before the contract of supply or under the contract of simple meaning. They are trying to tell that if the grass is being cut and sold, it is goods. If it is sold along with the land, it is not goods, it is immovable property. The grass is being cut and sold, it is goods. But if it is sold along with the land, if the trees and the grass are sold along with the land, then they are immovable property. Schedule 3 will be there. No GST. No GST. Right. What is the actionable claim? What is the actionable claim? A claim against which you can take an action in court of law. A claim against which you can take an action in your court of law. So when you talk about your actionable claim, it is a claim to a debt other than secured debt or beneficial interest in movable property. A debt which is not secured by mortgage of immovable property or pledge or hypothecation of movable property. Unsecured debt. Unsecured debt. Classic example. Your debtors and insurance claim. Your sundry debtors and insurance claim. If they are failing to pay you, what are you going to do? File a case in court. There's a claim that you have, but you're not able to get that amount. Please file an action and file a case in court. Actionable claim is goods. But I'm not telling that it will attract GST, because when you see schedule 3, all actionable claim are outside the ambit of GST other than betting, gambling, lottery, which is the second part of actionable claim. A claim to beneficial interest in movable property. If you are winning in betting, gambling or lottery and if the opposite person is not paying you the amount, what is the thing that you can do? What is the thing that you can do? You're going to go to court. You're going to go to court. It is an actionable claim. It is an actionable. If you're, say, having time and if motivated by famous cricketers, you are going to MPL, right? Which you should not do, and you're trying to play a gamble and you win it. That is a betting. Clear-cut case of betting. You win it, and for some reason you're not getting the amount. What is the action that you're going to take? You're going to file a case. You're going to file a case. So betting, gambling, lottery is nothing but beneficial interest in movable property. Another case where it is an action claim. This will attract GST. This will attract, because schedule 3 tells that actionable claim other than betting, gambling, lottery will not attract GST, which means it is outside GST. So what is inside GST? Betting, gambling and lottery is inside GST. Inside GST. So that is the meaning of your actionable claim. That claim can be existing, accruing, conditional, contingent, not relevant. It can be there, existing or accruing simultaneously, or contingent, it may be there, or conditional. That is not essential. It may be any of these. The meaning of the term actionable claim. Meaning of the term actionable claim. So when you go back to the definition of your goods, summarize goods. Movable minus money and securities plus actionable claim plus growing crops and grass which are cut down and sold. Which are cut down and what are services then? Anything other than goods minus money and securities plus again two things here. Plus again two things. One, you're talking about activities relating to use of money or its conversion by cash or any other denomination from one form or to another form, for which means charges related to mere transaction in money. Charges related to transaction in money. It also includes facilitating or arranging transaction in. So it also covers 2 points. Service charges related to transaction in money. Service charges related to transaction in securities. Money and securities are outside GST. But the service charges related to transaction in money. If you're getting a loan, that is mere transaction money. No GST. But that is the processing fees. Service charges related to transaction in money. Pay GST. If you are investing in shares, mutual funds, that is No GST, transaction securities. But if there are some charges, say for example, you are going to mutual fund, that is an entry load. Charges. It will attract GST. It will attract GST. The broker is charging its amount, brokerage. That will attract GST. Are you guys clear with this understanding? Again, it also has two parts. Don't remember the lengthy part. Two parts. Charges for money transaction, charges for securities transaction. Charges for money transaction, charges for securities transaction. So what is the summary of services? Anything other than goods minus money and securities plus charges related to money transaction, charges related to securities transaction. That is the definition of services. Now, what is money and what is securities? Because it was covered in both. Money is nothing but your Indian legal tender, includes foreign currency, includes all types of negotiable instrument. I am not going to read the list. Check, promissory note, letter of credit, etc., etc. All types of negotiable instruments. It also includes any such similar instrument which is recognized by RBI. So when you are making payment to GPay or Paytm, it's all recognized by RBI. Recognized by RBI. Right. Obviously, when you talk about crypto, it is not still recognized. It is still under hold. So that I am not covering. So that is the relevance of the term recognized by RBI. Recognized by RBI. But money will not include what? A currency that is held for the purpose of its numismatic value. So if I am a person who's having old coins, old currency notes, and if I get something from you and I pay by that old coin, is it monetary consideration or non-monetary consideration? Non-monetary consideration. Why? That old currency, supposing I'm old currency is say 25 paisa. That value is not 25 paisa. The real worth of the 25 paisa would be in thousands or lakhs or crores. So that is a non-monetary consideration. That is non-monetary consideration. Because the worth of that note is not worth. I'll make you very simple. There are certain currency notes which are having special serial numbers. Special serial numbers. Very special serial numbers. Right. So that special serial numbers, it can be a 2000 rupees note, but with a special serial number. Right. In market, that 2000 rupees note will not be worth 2000 rupees. It can be even 20,000. Right. So it is having a numismatic value. It cannot be called as money. It cannot be called as money. Why? I may sell a goods or service worth of 1 lakh rupees. I may get only that special note with a special serial number, which is only 2000. Now, my value is 2000 or 1 lakh. Have I sold the goods for 1 lakh or 2000? The sale was 1 lakh. The moment I get that 2000 rupees note, that is not monetary consideration. It is. So the moment it is non-monetary consideration, you are not covered under section 15. You are shifted to valuation rules. You are shifted to, specifically you are covered by your rule 28. Right. So you are going to shift to your valuation rules. The definition of money. Only remember the keywords that we have discussed. Right. That is the meaning of money. What are securities? Any kind of securities. Any kind of. It can be shares, scrips, stocks, bonds, debentures. It can be even derivatives. Security receipts, government securities. Can be even your mutual fund units. See, this definition is in fact taken from your securities contract regulation. The same definition is covered here. It can be instruments or certificates issued by special purpose entity, but that special purpose entity, it should be freely tradable in all the industries. So there's a clarification telling that when you talk about your MEI script is not there now, it is RODT EP script. Right, you have SCI script, RODT EP script, SCI script, renewable energy certificates, banking sector you have periodic sector lending certificates. They cannot be called as securities. They cannot be called as securities. Why? Though they are instruments or certificates issued by special purpose entities, but they are not freely tradable across different industries. That being the case, they cannot be called as securities. If they are not securities, they are goods to attract GST. So when you talk about your RODTEP, when you talk about rebate or duties and taxes on export product, RODTEP script, which is there in your foreign trade policy, or SCA strip, service export from India scheme, or renewable energy certificates or your priority sector lending certificates. Though it looks as if they are instruments issued by special purpose entity, but they are not freely tradable. Therefore, they are not securities. They are not, the moment they are not securities, they become goods, attracting GST. Right. Next, you are talking about any other instrument which is declared as securities by the government. If government declares any instrument as security, it is security. And finally, you are talking about right or interest in securities. Even right shares, even sale of rights is nothing but securities. It's nothing but securities. So you're talking about the definition of securities. Why we have seen the definition of money and securities? Because both money and securities is neither goods nor services. The transaction of money and transaction of securities will not attract GST. But the related transaction charges surrounding money transaction, charges surrounding securities transaction, that will surely attract GST. Are we guys clear with this understanding? So when you talk about your basic understanding of your levy, it was all about your first three P's were all about your product, goods or services which you have completed, process which you have to see, and place. Intrastate, which you have completed. Now the entire focus is on your process, supply. The entire focus is on your process, which is supply. When we talk about the third P, when you talk about your process, that is supply. Product is good services. Your place is interstate, intrastate, and when you talk about your process, which is supply, it has to be read in a special manner. Process is equal to actual supply plus deemed supply minus not supply. And the definition of supply is so crucial that they have not defined the definition in section 2. It is defined in section 7 of your CGST Act. Section 7 of your CGST Act. So it is actual supply plus deemed supply minus not supply. When you talk about your actual supply, it should have everything. There should be an activity which is supply. It should be for business and it should be for consideration. We'll do one thing. We'll just try to understand actual supply, deemed supply, and not supply separately. So what is important for you to understand is, first you have to find out supply, actual supply plus deemed supply minus not supply. Once you find that it is supply, then you have to find out the nature of supply, whether it is supply of goods, or supply of services. So supply is equal to actual plus deemed minus not. Once it is supply, then you have to find out whether it is supply of goods or whether it is supply of services. So when you talk about your term supply, supply includes all forms of supply. All forms of supply. All forms. Be it sale or transfer or disposal or barter or exchange or lease or license or rental or any other form. All forms. These are only examples. Supply includes all forms of supply. Any activity. All forms of supply. These are examples. Sale, transfer, lease, sale, transfer, disposal, lease, license, rental, barter, exchange. These are only examples. It should be in course or furtherance of business. In course or furtherance of business, and that should be consideration. That should be consideration. You should have a consideration. That should be an activity, any activity. It should be in course or furtherance of business, and in return there should be a consideration. That should be a consideration. Actual supply, part 1 is this. All these three, actual supply, deemed supply, and not supply, have got two parts. This is the first part. This is the first part. And when you talk about your second part, this is your part 1 of actual supply. Part 2 of actual supply, you will find that it looks pretty similar. Part 2 tells that when you talk about supply, it can be any activity, but that activity should be between your club and its members. Non-individual is nothing but clubs or association. Here this non-individual is nothing but you're talking about your club or any association and its members. Both will be treated as separate persons. The club and the members will not be treated as the same person. They will be treated as separate person. So that is activity. It can be any activity. When you talk about business, you will find that business is also present. How? When you see the definition of business, business specifically tells that any activity between clubs and members is business. So when you are looking at the term business, it has got a point, section 2, clause 17, subclause E, which tells that provision by a club, association or society for a consideration or a subscription to the members is nothing but business. Is nothing but business. So business, though not specifically mentioned, it is there. It is there. When you look at the definition of business, you will find this specifically included. So business is also there. And it should be for a consideration. It should be for a, you will again find that everything is the same. Activity can be any activity. It is in course of furtherance of business, because the definition of business includes transaction between club and its members, and it should be for a consideration. Then this repetition is for what? This is only to overrule a Supreme Court judgment which was there in Calcutta Club Company, which said that clubs and members are the same. Therefore, there cannot be any supply between the same person. I cannot supply to myself. I cannot supply to overrule that Supreme Court judgment. This is added. Other than that, you will find everything is the same. Activity can be any activity. It is in course of furtherance of business. Silently, if you look at the definition of business, it should be for a consideration. So the essence of this point is only to tell that clubs and members are not the same. They are separate persons. They are separate persons. That's the only essence of this. That's the only essence of this. Otherwise, actual supply part 1, actual supply part 2 are exactly the same. Any activity in course of furtherance of business for a consideration is actual supply. Part 2 clarifies that club and members are not one and the same person. They are separate persons. Now, what is business and what is consideration? When you talk about business, you have to read the definition of business in this way. 2 plus 2 plus 5. 2 defines business, 2 clarifies the scope of business, and 5 has specific clarification. 2 plus 2 plus 5. The first point tells that for you to do a business, normal business understanding is trade, commerce, manufacture, a profession, vocation, adventure, or such similar activity. It's a normal definition that you read. But the special point here is whether or not for a pecuniary benefit. Your trade, commerce, manufacture, profession, vocation, etc., etc., your intention to earn profit is not relevant. Actual earning of profit is also not relevant. So whether or not it is for a pecuniary benefit, it will be treated as business. So all the trusts which are selling goods or supplying services, they cannot take a shelter that they are non-profit organization. Your intention to earn profit is not relevant. Whether or not for a pecuniary benefit. That's the main point of the first part. Second part, incidental or ancillary. When you're doing any main business, there can be incidental or ancillary business. Which means, if at all I am dealer of a motor vehicle, I may even sell accessories, motor vehicle accessories. Take classic example of Royal Enfield. Now the business of Royal Enfield is not only by selling the main vehicle, earlier it used to be. Now it is also generated by way of selling accessories. Why not only that? Even service station. Right. Now all the automobile companies have understood that there's a big amount of revenue in service. Earlier, few years back, maybe you go back 10 years back and all, not all the companies had their own service station, or even if they had only in major cities. You'll find that they'll be there in most of the cities. Why? Business opportunity, incidental or ancillary. That is also attracting GST. Definition of business, main plus incidental. That main pecuniary benefit is not relevant. That's the definition of business. Then what are the next two? Next two are clarification for all the industries. What is the first clarification? The first clarification is your volume, your frequency, your regularity, your continuity is not relevant. What is the number of units that you manufacture or sell? It's not relevant. So volume is not relevant, frequency is not relevant, continuity is not relevant, regularity is not relevant. Even if you're doing a business part-time, that is business. Even if you are a chartered accountant and every now and then you also become a real estate agent. Obviously professional ethics will not allow, but just for understanding purposes. Right? You're a part-time real estate agent. That is business. That will also attract GST. That will also attract GST. Right? Clarification. Volume, frequency, continuity, regularity is not the criteria for defining business. Next, clarification is, even if you are selling your capital goods and services at the time of sale, acquisition is for input tax credit, sale is for your, disposal is for your attracting GST. Even if you are selling your capital goods services, that will also attract GST. Running an academy, I require a lot of capital assets. If we start selling my old capital goods and purchase new capital goods, on sale of old capital goods, be it projector, table, benches, anything, this computer system, that will attract GST. I cannot tell that I am running a coaching academy institute, therefore I will pay GST only on my coaching class revenue, not on my sale of capital goods. Even sale of capital goods will attract GST. Even sale of capital services will attract GST. So that is a clarification. These two are clarifications. Your continuity, regularity, volume, frequency, not relevant. Even when you are selling your capital assets or services, that will attract GST. Now, these are the first 5 points. Now, the next 5 points. So, when you talk about your next 5 points, we have seen the 5th point already. You're talking about what? You're talking about your clubs and members. Any provision of service by a club, association or society to its members for a subscription or consultation is business. This is only specific to club. So, let us highlight only the term. Specific clarification only for clubs and association. Clubs and association. That whatever they are doing, it will be called as business. Second specific clarification is for admission to a premises. Lot of places, be it zoo or wildlife sanctuary or be it your Statue of Unity, right, in India, Statue of Unity, be it any place where you have to pay an entrance fees to go to that premises. This is nothing but business. You have to pay GST. Admission to premises, admission. Right. Next, you are talking about a scenario where you are talking about a special person who's supplying, the service which is supplied by a person who's holding an office in because of his trade, profession or vocation. Say for example, a chartered accountant is appointed as an independent director in a company which is under insolvency. Now, he may have his own cabin. You may look at him as an employee of the company, but in reality, he is not an employee of the company. That attracts GST. Now, you are holding that office in course of your business, profession or vocation. Classic examples are independent directors. They are not employees. From the outside, you may treat them as employees, but in reality, they are not employees. SAP consultants. You will see SAP consultants sitting in the company itself with a separate cabin, but they are not employees. Concurrent auditors. You'll see concurrent auditors or internal auditors sitting in the client's place. They may have a separate cabin for themselves, but they are not employees. They will collect professional fees which will attract GST. Their amount is not salary. It is not salary. If it is salary, it is outside the ambit of GST. It is professional fees which will attract GST. Which will attract GST. Next, you are talking about race club. Activities of a race club, including by way of an automated machine totalizer. You're doing betting, gambling, lottery, that will attract GST. Again, a clarification. Finally, you're talking about activities by government. Even government doing an activity, even if it is a statutory obligation, statutory function, public authority, which means only government can do. Even that will attract. Levy is there. Collection may or may not be there, but levy is there. Right, specific clarification of for whom? Special categories. Club, premises, holder of an office, race club, government. They are not talking about all the industries. They are talking about special sectors, be it club or be it premises, admission to premises, or be it holder of an office, or be it race club, or be it government. They are all doing business, so that tomorrow no one can stand up and tell that whatever they are doing is not called as business. Therefore, it will not attract GST. They want to be very specifically telling that these persons, whatsoever they are doing, we will treat it as business. And therefore, it will attract GST. If other conditions are satisfied, it will attract GST. Definition of business. Definition of your business. So, when you see your actual supply, you understand that there should be an activity, any activity in course of furtherance of business. We have understood what is business for consideration. Now, what is consideration? Meaning of consideration. Consideration can be monetary or non-monetary. Consideration can be monetary or non-monetary. In case of non-monetary, it is monetary value of non-monetary consideration. It can be money or other than money. By the way, consideration is nothing but something in return. That something in return can be money or other than money. That something in return is for an activity, which is actually an activity or refraining from doing an activity. You are getting something in return for doing an activity or promising not to do an activity, forbearance to do an activity, tolerating an activity or refraining from doing an activity. Consideration is something in return for doing an act or promising not to do an act, forbearance to do, not to do an act, promising not to do an act, refraining from doing an act. It can be money or other than money. It can be paid by recipient or any other person on behalf of recipient. Any other person on behalf of recipient. Right? If I am supplying services to you, you can pay me or someone else on your behalf can pay me. Now, what is not included in your consideration? This is all understanding of the term consideration. When you talk about subsidy given by the government is not part of consideration. If subsidy is given by government, it will not be included in the term consideration. Subsidy by government is not part of consideration. Subsidy by other than government, it is part of consideration. Subsidy by government company, it is part of consideration. Subsidy by government, not part. Other than government, part of government. Other than government includes government company. Other than government includes, it will be part of consideration. And when you talk about your term consideration, it will never include loans and deposits. Not only deposit but also loans. Mere transaction in money. Loans and deposits are never included in the term. Not only this deposit but also your loans. Your loans and deposits will never ever be part of consideration. Why? Mere transaction in, they will be repaid back. They will be repaid back. So loans and deposits are never part of consideration, but advance is part of consideration. Advance is part of, loans and deposits is never part of consideration, but advance is part of. And when you talk about deposit, normally deposit is not part of consideration. But when a deposit is forfeited, it will no more be called as deposit. When you pay a telephone deposit of 5,000 rupees, no GST will be attracted. If you are not paying your telephone bill for continuously say 3-4 months and 3,000 rupees is adjusted or forfeited, now that 3,000 rupees becomes consideration. That will attract GST. 2,000 still remains deposit. That will still not attract GST. So that is the definition of the term consideration. Of the term, it is something in return for doing an act or promising not to do an act, monetary or non-monetary, paid by recipient or any other person on behalf of the recipient, but it will not include subsidy by government. Subsidy by other than government included. Government company included. It will not include loans and deposits. Advances included. Forfeiting the deposit included. That is part of consideration. That is all about the term actual supply. Actual supply is equal to actual supply plus deemed supply minus not supply. We are done with the term actual supply. Now we are focusing on the term deemed supply. And the entire definition is discussed in your section 7. Deemed supply. Deemed supply also, just like your actual supply, has got two parts. Part 1 and part 2. Part 1 and part 2. Deemed supply is also having two parts. Now part 1 focuses on what? Part 1 only focuses on activity being importation of services. Only being importation of services. It should be for consideration. So activity is not any activity. Activity is only importation of services. Business may be there, may not be there. It may be in course of furtherance of business or it may not be in course of furtherance of business. But consideration should be there. So activity is importation of services. Business may or may not be there. Consideration should be there. Should be there. Why the focus is only on importation of services, why not on importation of goods? Importation of goods is all subject matter of your customs. It will be taken care in your Customs Act. Right. So importation of services for consideration, business may or may not be there. It's not talking about any activity. It is only talking about importation of services. And part 2, deemed supply part 2. Deemed supply part 2 talks about again about specified activities, not any activity. Deemed supply part 2 talks about activities given in schedule 1. So here again activity is not any activity, it is 4 notified activities of schedule 1. 4 notified activities of schedule 1. Business is silently there. Though nothing specifically is mentioned about the business, but it is silently. When you see the 4 special activities of schedule 1, you will find that business is there. Silently it is there. When you look at the 4 paras of schedule 1, in every para there will be a clear-cut hint that business is there. Business is very much there. And consideration. Consideration should not be there. So consideration is not that. Schedule 1 is otherwise called as supply without consideration. Supply without. Now what is the differentiating point here? Here activity is only 4 notified activities of schedule 1. Business should be there. Consideration should not be there. Whereas your part 1 of deemed supply is only importation of services, not 4 activities, only importation of services. Consideration should be there. Business may or may not be there. May or focus is more on not be there. If it is business is also there, then it is actual supply. Focus is more on business not be there. So the events which are present and absent interchanges in deemed supply part 1 and deemed supply part 2. Right? When you see deemed supply part 2, which is schedule 1, 4 paras, otherwise called as supply without. First we will see the 4th para, because 4th para also talks about importation of services. 4th para also talks about your importation of services. It tells that there is importation of services. Right? Which is without, but obvious that it is without consideration, because schedule 1 by default tells that it is without consideration, but business is present. Importation of service should be in course or furtherance of business. Should be in course or furtherance of business. But that's an extra condition. It should be from a related person or branch office outside India. That is an extra condition. Related person or branch office outside India. Now, let us try to understand this. Importation of services, I am not focusing on actual supply. My focus is only on deemed supply. If at all importation of services is with consideration and business not there. If it is with consideration, business is also there when what it is? Actual supply. With consideration, without business, deemed supply, part 1. If it is without consideration and business is there, it should be from related person or branch office outside. Only if this condition is satisfied, then it is deemed supply part 2. If at all it is consideration is not there, business is there, but if it is from unrelated person, it is not supply. If consideration is not there, business is also not there. Forget about the fact that it is from related person or not related person. Not a supply. This is the entire summary chart. The deemed supply part only lies here. When your consideration is there but business is not there, need not worry, it is directly deemed supply part 2. You need not check whether it is from related person or branch office outside India. But when business is there but consideration is not there, there should be an extra condition that it should be from related person or branch outside India. If that condition is not satisfied, then it is not supply. Here you don't have that extra condition. Here you have that extra condition. Difference between your deemed supply part 1 and deemed supply part 2 with respect to importation of services. Importation of services. Right. So when you talk about your deemed supply part 2, schedule 1, how many paras are there? 4. Out of which 4th para we have seen first because it was connected to deemed supply part 1. So we have compared and closed that. Now let us see the other paras. If you focus on the 4th para, the focus was only on services, correct? The entire focus was only on services, importation of services. Now let us see schedule 1, first para. What is first para? First para talks about permanent transfer or disposal of business assets on which ITC has been availed. That should be permanent transfer or disposal of business assets on which ITC is availed. On which ITC is, clearly we are talking only about two things, either gifts or free samples. Only in case of gifts and free samples you permanently give up the title, transfer or ownership, because it should be without consideration. Schedule 1 means it should be without consideration. So here you are talking only about gifts and free samples. Gifts and free samples. You have permanently given those business assets on which ITC has been. If you take input tax credit, you have to pay output tax. It is called as deemed supply by way of para 1, schedule 1, and you have to pay output tax. Here the focus is mainly on goods. Services also can be there if you understand at a higher level, but for your exams the focus is mainly on goods. Permanent transfer or disposal of business assets on which ITC has been. If you don't avail ITC, if you give, if I am going to give you gifts of free samples, first I should have purchased it. On purchase, if I have taken the credit, when I am giving it as gift to you, I should pay output tax. On purchases, if I have not taken the credit, when I am giving you as a gift of free samples, I need not pay output tax because it is not covered by schedule 1, para 1. Schedule 1, para 1. The next para 2. Para 2 talks about supply between related person or distinct person. Supply between related person or distinct person. What is related person? What is distinct person? We'll understand. But now understand supply between related person or distinct person. Right? It should be in course of furtherance of business. Again, it should be in course of furtherance of business. You will find business silently there. In the first para, business was silently there when you see the term business assets. In the second para, in course of furtherance of business specifically. In the third para, principal agent. You'll have principal agent relationship only when there is business. And fourth para. So if you remember when I was explaining part 2, I said businesses silently there in all the 4 paras. Now coming back to para 2, supply between related person and distinct person. Supply between related person and distinct person will be deemed supply even if it is without consideration. Here the focus is both on goods as well as services. The supply can be of goods as well as of that of services. As well as that of, that's a difference between the term related person and distinct person. Related person involves 2 companies, 2 persons. I mean, not necessarily 2 companies, 2 persons. Person 1, person 2. Distinct person involves only 1 person. Only 1 person. But having different GST number. Same company having different GST number. When I tell company, don't focus on the term company. I'm talking about a proprietorship concern or a partnership firm or an LLP or a company, but having different GST numbers. So same PAN number, but different GST number is distinct person. Related person, different PAN, but they are related. Different PAN, but they are related. It is highly possible when the transaction is between related person or distinct person, it might be without consideration. It might be without. Therefore, they have brought this deemed supply. Deemed supply. Are you clear with this understanding? Are you guys clear with this understanding? What is meant by distinct person? Same PAN, different GST number. Related person? Different PAN, but they are related because of what? Let us see the definition of related person now. What is related? All the definitions that we have discussed are all covered in section 2. But here we are discussing the definition of related person, which is given in your explanation to section 15, which is a valuation provision. Explanation to section 15. Person shall be deemed to be related. Split that into 3 parts. Split that into 3 parts. First part. If they are officer or director in one other business. If I am director or officer in Praveen's business and Praveen is officer or director in my business, both of us are a related person. Or if you are talking about employer-employee, any transaction between employer-employee will be called as related person transaction. Or if you are talking about partners, if at all you are talking about partners in a partnership firm, Any transaction between one partner to another partner. I'm not talking about partner to partnership firm. One partner to another partner. It will be called as related party transaction or members of the same family. Any transaction between the members of the same family. And when you're talking about members of the same family, please understand we are only talking about a proprietorship concern and HUF. Only about proprietorship concern and HUF. We are not talking about other than proprietorship concern and HUF. So when you talk about proprietorship concern, who is member of your family? Who is member of your family? It is very limited definition. Very limited definition. The members of your family is only when you're talking about your spouse and children, which is unconditionally, whether they are dependent or independent. But when you talk about your parents, grandparents, brothers and sisters, they are your related person only if they are wholly or mainly dependent on you. So if you see the questions of ICA, they will play with this. Transaction between two brothers. Both are independent. One is a businessman, one is a professional. Both are independent. Whether it will be a related party transaction? No. It will not be hit by para 2. It will not be hit by para 2 because they are not related person. But if I replace the same example with spouse, right? Mr. Trump and Mrs. Trump, both are say independent. Now, the transaction is a related party transaction. Transaction is a related party transaction. So first part talks about four points. Officers or directors in one other's business. When you're talking about the second part, employer-employee, legally recognized partners, and finally, members of the same family. And we have seen what is meant by family. The second part talks about control by third person on our subject persons or by the subject persons on the third person. Now, who are the subject persons? Subject persons are those persons between whom the transaction is happening. So let us keep the subject person as VJ and PJ. Now, if the subject persons are these two, in the entire discussion, the focus is only on the transaction between VJ and PJ. Other persons will be having some control or being controlled by them. But the transaction is happening between VJ and PJ. Now let us understand with that understanding. First point, one of them controls the other. Which means either VJ Limited controls PJ Limited or PJ Limited controls VJ Limited. There's no third person involved. One of them controls the other. When you talk about control, it is just like your AS or Ind AS, where you're talking about not only about financial control but also managerial control. One of them controls the other. Both are related party transaction. Either VJ controlling PJ or PJ controlling VJ. The supply can be from VJ Limited to PJ Limited. But if one of them is controlling the other, it is the related party transaction. Next, both of them are controlled by third person. Both of them are controlled by, which means there is another entity now brought into picture, but that is not the subject entity. Supposing say Vidyapeeth controls VJ and PJ. We are not talking about Vidyapeeth in the transaction. The transaction is only between VJ and PJ. So Vidyapeeth controls VJ and PJ. VJ and PJ will be called as related parties. Vidyapeeth is having 51% shares in VJ Limited, also having 51% shares in PJ Limited. Who are related person? VJ and PJ are related person. Obviously, Vidyapeeth and VJ also becomes related person because of the first point, not because of the second point. Correct? So you are talking about second part being both of them are controlled by. So moment you see the second point, your attention should be there at the last point. Any person, again any person means third person, Vidyapeeth, directly or indirectly owns, controls or holds 25% or more shares in both of them. Which means again Vidyapeeth is not having 51% in VJ and 51% in PJ, but it is having 25% in VJ Limited and 25% in, even then it will be called as related party transaction. Which transaction? VJ Limited and PJ Limited. VJ Limited and PJ Limited. Now the essence of this is, the fourth point is wide enough to cover the second point. Actually the fourth point is wide enough to cover Even if second point was not the related person would have been the same. More than or equal to 25% covers 51%. So fourth point is wide enough to cover the second point. Are you clear with this understanding? But one technical difference you can have, here the focus is only on financial control, 25%. But there it is financial as well as managerial. So that technical difference you can have. And finally, the last point, together they control third person. Now together they control third person means VJ Limited and PJ Limited together they have 51% control in Vidyapeeth. Maybe VJ Limited is having say 35% and PJ Limited is having say 16%. Together they are having 51% in Vidyapeeth. Therefore, who are related? VJ and PJ. Vidyapeeth is an outsider. Right? The transaction was only between VJ Limited and PJ Limited. Are you guys clear with this understanding? Please understand that fourth point was wide enough to cover second point. Right? If I were to tell in a very simple manner, first point, VJ Limited, PJ Limited. Second point, you're talking about Vidyapeeth, VJ Limited, PJ Limited. And finally, you're talking about VJ Limited, PJ Limited, Vidyapeeth. The first point, one of them controls the other. Second point, third person controls both or is having more than 25% voting share in both. So here the percentage was 51%, more than 50%. Here initially it is 51%, but suddenly it tells that even 25% is sufficient. And finally, it is VJ Limited and PJ Limited. Together they have, when I'm writing 51%, it means more than 50%. It's not necessarily 51%. More than shareholding can be even 50.1%. That was also possible. In all these cases, the focus was only between transaction between VJ Limited and PJ Limited. Right. And the last part of this related person. One is sole agent or sole distributor or sole concessionaire of the other person. If Reliance Limited appoints me as a sole agent across India, I have relationship between Reliance Limited. The transaction between Reliance Limited and myself will be called as related party transaction because I am the only agent. So there will be a huge influence on me by Reliance Limited. They'll ask me to do something and I have to do. Correct. So a sole agent will have a great amount of influence. Therefore, they are called as related person. Related person. One agent across India. One agent across India. But in customs, you will find exactly ulta. In customs, they'll tell that just because you are sole agent, you don't become related person. In GSC, you are a sole agent, you become related person. In customs, just because you are a sole agent, you don't become related person. That's the first difference. Second difference in customs, this 25% is not 25% in customs, it is 5%. It is 5% is sufficient. In one way, customs is liberal. Another way, customs is stringent. Right? So in customs, if you understand related person definition, make two changes. Here 25%, in customs it is 5. Here sole agent means related. That sole agent will not make you related by default. You have to be covered by other points. Just because you are a sole agent, you will not become related person by default. So that is the definition of related person. Now why we saw the definition of related person is because of para 2. What is para 2 telling? Transaction between related person will be called as supply. Even if there is no consideration, it will be called as supply. What are the 2 points covered in para 2? Related person and distinct person. Now please understand this way. If at all a transaction is between related person, VJ Limited, PJ Limited and distinct person, PJ Limited GSC number 1 and VJ Limited another GSC number, the same GSC number for the first case. If at all it is with consideration, there can be a transaction between related person for consideration. If it is for consideration, it is actual supply. If it is for consideration, it is actual supply. We are assuming that they are related person. But if it is without consideration, assume that consideration is not there. If it is without consideration, if at all they are related person, still it will be called as deemed supply. Deemed supply. That will be GST for sure. But when you talk about, here our entire focus is on the term related person. Here we are trying to understand distinct person. If at all you are talking about only one person, multiple GST number. If I tell the GST number is the same, one branch office to another branch office, GST number is the same. It cannot be called as distinct person. Because for you to be a distinct person, it should be between same person to GST number. If it is not distinct person, it is neither actual supply nor deemed supply. And obviously between branches, there will never be any, but implied, there will not be any consideration. But if at all you are talking about, say, VJ Limited and VJ Limited, same person, but GST number is different. GST number 1 and GST number 2. It may be same state or different state. Normally it is different state. If at all you are working in different states, you have to take multiple GST number mandatorily. Even within the same state, at times you may opt for multiple different states. Mandatorily you have to go for different GST number. Same state you may opt for multiple GST number. So I am just telling that is separate GST number. The moment it is a separate GST number, obviously whether it is same GST number or separate GST number, there will not be any consideration. If it is a separate GST number, now you become distinct person. Now the transaction will be deemed supply. Now you can clearly look at the differences. When you talk about related party transaction, with consideration, actual supply. Without consideration, deemed supply. When you're talking about transaction between branches of the same company, within the same GST number, not supply. Between different GST number, deemed supply. Between different GST number, deemed supply. And whenever I hear whatever is deemed supply is because of your para 2 of schedule 1. Para 2 of your schedule 1. But in this para 2 of your schedule 1, there is an exception. If at all, and that exception is only for employer-employee, not for any other related person. Only for employer-employee. If at all, employer is giving gifts not exceeding 50,000 per year per employee, it is not supply, neither not actual supply nor deemed supply. But when the value of the gift is less than 50,000, less than 50,000 per year, per financial year per employee. So if a company is giving gift, whether it is supply or not, if a company is giving gift, if Tata Limited is giving gift, whether it is supply or not, Tata Limited is giving gift to unrelated person, to related person but not being employees, to related person being employees. What will happen? Tata Limited is giving gifts to all of them. What will happen? And Tata Limited in the first case has availed ITC, in the second case has not availed ITC. And the gift value, supposing it is less than 50,000, more than 50,000. It's less than or equal to 50,000, more than 50,000. Less than or equal to 50,000, more than 50,000. What will happen? If at all it has availed ITC, answer is same. Deemed supply, para 1, schedule 1. Finished. Whether it is to unrelated person, related person, employees, less than equal to 50,000, more than 50,000, not relevant. Not relevant. But if it has not availed ITC, if Tata Limited has purchased items for giving gifts, but it has not availed ITC, Tata Limited has decided not to avail ITC at the time of purchase. For me to give gifts of free samples, first I should have purchased it. And at the time of purchase, I decided not to avail ITC. In that case, unrelated person, if I have not availed ITC, not supply. Related person, whether I have availed ITC or not availed ITC, whether the value is less than or equal to 50,000 or more than 50,000, it is deemed supply. Para 2, schedule 1. Para 2, schedule 1. I am not hit by para 1 now. I am hit by para 2. And if it is employees, if I have not availed ITC and the gift value is less than or equal to 50,000, not supply. But if the gift value is more than 50,000, deemed supply because of para 2, schedule 1. Because of para 2, schedule 1. Para 2, schedule 1. In the first case, when I avail ITC, the entire focus is only on para 1. If I have availed ITC, forget everything. To related person, unrelated person, employees, less than or equal to 50,000, more than 50,000, forget everything. It is deemed supply. Para 1. If I don't avail ITC, then different answers will be there. If it is to unrelated person, no ITC, not supply. If it is to related person, even if no ITC, deemed supply, para 2, schedule 1. If it is employees and if I have not availed ITC, if it is less than 50,000, not supply. If it is more than 50,000, deemed supply, para 2, schedule 1. Para 2, schedule 1. So that is the understanding of your gifts free samples in totality. Reading both para 1 of schedule 1 and para 2 of schedule 1. And finally, when you're talking about the last thing which is pending in your schedule 1 is, you're talking about transaction between your principal and agent. Again, here the focus is only on goods. Transaction of goods between principal and agent. But understand, you are not talking about a normal agent. You are talking about an agent who is having the authority to raise invoice under his own name. We are not talking about a normal agent. We are talking about a special agent who is having authority given by the principal to raise invoice to the customer under his. Customer will always think that this agent is the owner. Customer will never know that he is not the owner. So we are not talking about a normal agent. We are talking about a agent as per schedule 1, which loosely we are calling it as special agent. In case of normal agent, what is the type of transaction? If at all you are talking about normal agent, the transaction is different. Special agent, the transaction is different. What happens in case of normal agent? What is the transaction? 3 persons are involved. Principal, agent, customer. In normal agent, what happens? In normal agent will raise invoice to the principal for his commission and principal will raise invoice to the customer for the selling price. So in normal agent, the transaction is agent to principal, principal to customer. Agent to principal, it is actual supply of services, commission. And principal to customer, it is actual supply of goods. That is actual supply. That is not deemed supply. Principal will give commission, actual supply. Customer will give selling price, payment, actual supply. But in case of special agent, the transaction changes. Because who will finally deal with the customer? Who is going to give invoice to the customer? Special agent. So principal will give goods to special agent and agent will give goods to customer. That is not the criteria, by the way, who is giving goods. What is the criteria? Agent will give invoice in his own name to the customer. So when agent is giving invoice in his own name to the customer, that is actual supply of goods between agent and customer. First we'll understand the second part of the transaction, agent and customer. That is the actual supply of goods. And because of that, it becomes important to tax even the first part of the transaction to make sure that credit continuously flows. Therefore, the first part of the transaction, principal, when he is giving the goods to special agent, ownership is still with the principal. There's no consideration being there. So it is not actual supply, but it is deemed supply of. Why there is no actual supply? Because please understand, here there will be no consideration. Here there will be consideration. But in case of normal agent, there was consideration in both the points. Principal will give commission to agent, actual supply of services. Customer will give price to the principal, actual supply of goods. But in case of special agent, though customer is giving payment to the special agent, it actually belongs to principal. So special agent to customer will think that special agent is the owner. So actual supply of goods, consideration is that. But principal to special agent, when the goods are going from principal to special agent, there was no consideration. It is not actual supply. It is deemed supply of goods. Deemed supply of goods. Commission will not again be taxed. Remove this point that commission will be involved here. Please understand this point that your books will never match with GST. Even in this second case, agent will get a commission. That again will not be taxed. Because that commission is indirectly taxed and agent is collecting GST on price from the customer. So your books of accounts will be different from your GST records, both for principal and agent. Your books will not match with GST. Don't confuse yourself thinking of your books of accounts. Your books will go in a different manner and your GST records and returns will go in a different manner. Are you guys clear this understanding? So here the focus is on what? Special agent. Principal to special agent, deemed supply of goods. Special agent to customer, actual supply of goods. There's no service element. There's no tax on again commission. It is indirectly taxed. When finally GST is collected on the price given by the customer, it includes commission by default. Finally it is taxed. It's not that tax is going escaped. No, it is finally taxed. And input tax will flow. In the first case, agent will pay output tax, principal will take input tax credit. Principal will pay output tax, customer will take input tax credit. In the second case, principal will pay output tax, agent will take input tax credit. Special agent will pay output tax, customer will take, if they are eligible, they will take input tax credit. That continuous chain of credit will be there. That will be surely there. That's all about your deemed supply. Everything. Part 1 as well as Part 2. Part 1 only focusing on importation of services. Part 2 focusing on Schedule 1, 4 cases. Schedule 1, 4 cases. Gifts, free samples, related person, distinct person, principal, special agent, importation of services, related person, branch outside India. Right. These are the 4 paras of your Schedule 1. Now, this area, this chart automatically we have completed when you have taken that example. It's all done. Now, when you talk about supply, what was supply? Supply is equal to actual supply, done. Part 1, part 2. Deemed supply, done. Part 1, part 2. What is the last part? What is the last part? Not supply. Not supply. So when you talk about not supply, again it has got 2 parts. Not supply again has got 2 parts. Part 1 and Part 2. Again it has got 2 parts. Part 1 and Part 2. Part 1 is nothing but Schedule 3, 8 cases. Schedule 3, 8 cases. Part 2 focuses on notified cases. What are the notified cases? We'll see. Notified cases. That is Part 1 and Part 2. What is there in Part 1? What is there in Part 1? Part 1 talks about first employer, employee. Employer, employee. Then MP, MLAs. Then court, tribunal. Then deceased. Then land and building. Then actionable claim. Actionable claim other than betting, gambling and lottery. Last 2 parts are only focusing on customs part. They are all customs related. One being your drop shipment, other being your high sea sales as well as sale of warehouse goods. Right. So there are totally how many parts? 8 parts. 8 paras in your schedule 3. Employer, employee, MP, MLAs, court, tribunal, deceased, land building, actionable claim, drop shipment, and you're talking about IC sales and sale of various goods. Now, when you talk about employer, employee, they are trying to tell in a very simple manner that salary or wages or remuneration received by the employee from the employer in course of employment or in relation to employment, in course of employment or in relation to employment is outside the ambit. So, laborers getting wages outside GST, laborers getting bonus outside GST, laborers getting gratuity outside GST in relation to employment. Salary and bonus is in course. Gratuity is in relation to employment. Laborers includes seasonal laborers. Normal employees getting salary outside GST, getting bonus outside GST because it is in course of employment. Normal employee getting gratuity outside GST. It is in relation to employment. Now, what about partners of partnership firm? Working partners of partnership firm, they are just like employees. Technically, they may not be employees, but for GST, they are just like. So, remuneration by partners. Remuneration by partners. Remuneration can be received only by working partners. Remuneration by working partners outside GST. Remuneration by working partners outside GST. Right. And finally, the focus shifts only to directors. So, you can talk about laborers, you can talk about employees, you can talk about privileged employees. Laborers, whether getting wages or bonus or gratuity outside. Employees getting salary or bonus or gratuity outside. Privileged employees. If you're talking about partners or designated partners, directors. Partners getting remuneration. Partners getting remuneration outside GST. What about directors? What about directors? If directors are getting remuneration because they are whole-time directors or managing directors, because they are managing directors or whole-time directors, and moreover the TDS deducted by the company is under section 192, which is nothing but TDS on salary, then they are just like employees, no GST. But if they are not getting remuneration, they are getting professional fees or sitting fees. The TDS by the company deducted is under 194J. Then obviously they are not employees, because even in income tax you are calling it as professional or technical fees, right? Therefore, this would be subject to GST and it is under RCM. Supplier is director, recipient is company. Company will pay GST under RCM. Company will pay GST under RCM. That is the entire understanding of your employer, employee. Employer, employee. Now, the second part. MP, MLAs. Who makes the law? Remember Article 245? Parliament or State Legislative Assembly. So, what they will do? Any amount received by MP, MLA or members of Panchayat or local authority. 3-tier structure. Central government, state government, local authority. So, members of Parliament, members of State Legislative Assembly or member of local authority, which is Panchayat or municipality, outside the ambit of GST. Outside the ambit of GST. Or person holding constitutional post. They are not MP, MLAs or a member of Panchayat or municipality. Classic example, President of India, Governor of the state, right? Chief Justice of India, or be it CAG, Comptroller and Auditor General of India. They are all holding a constitutional post outside the ambit of GST. Or you are talking about chairperson, member or director, not in government company. Not in, it is in a body established by government. Classic example, chairperson of CBDT or CBIC. A chairperson, because we are seeing indirect taxes, let us focus on Central Board of Indirect Taxes and Customs. That is a body of government. It is not a government company, it is a body of government. There will be a chairperson of CBIC, as well as there will be a chairperson of CBDT. They will be getting some amount that is outside the ambit of GST. MP, MLA, constitutional post, chairperson, member or director of government body, not government company. Call it as government body, not government. If you are a director in government company, independent director in government company, whether you have to pay GST? Yes, that will be GST. But under RCM. The government company will pay under RCM. Right. So that is the second part. Third, services of court tribunal outside the ambit of GST, including Consumer Dispute Redressal Commission. Technically, it is not tribunal, but it works like tribunal. Consumer Dispute Redressal Commission. It works like tribunal. Therefore, that is also covered here in terms of CBIC circular. Right. That is outside the ambit of GST. Not services of advocates or arbitrators. That is subject to GST. Services by court tribunal. You will be paying court fees, tribunal fees. That is outside the ambit of GST. Not the fees payment to advocates and arbitrators. That is within the ambit of GST. Next, you are talking about services by in relation to deceased. Funeral, burial, crematorium or mortuary, including transportation of deceased. That is outside the ambit of GST. That is outside the ambit of dangerous, but still they have said that that is outside the ambit of GST. Transportation of a person who is alive. It is within the ambit of GST. Levies are, but collection is not that. Exempted. Levies are, but collection is not that. Exempted. Land and building. Sale of land and building. Outside the ambit of GST. If it is sale of land and building, outside the ambit of land is always sold. Land is always outside the ambit of GST. If I am constructing a building where there are 3 floors given to A, B and C, UDS of land, undivided share of land is always outside the ambit of, what about the building portion? What about the building portion? Undivided share of land. Undivided share of land is always outside the ambit of GST. What about building portion? This is always outside the ambit of GST. Land value, land portion. How to find out the land portion? That is a separate question, not in your syllabus. But land value, land portion is always outside the ambit of GST. Now, what about the building portion? If A has given full advance, A has given full advance before the completion certificate or first occupancy. B has given partial advance, partial amount before and partial amount after, and C has given full payment after completion. What about A? A and B will be treated the same the moment you have given full advance or partial advance. Whether it is full advance or partial advance, you have given an advance and the opposite person is doing construction of building for you. So in both these cases, there will be construction of building. There is no change in A and B. Just because one is giving full advance, one is giving partial advance, there is no change. In both these cases, on construction of building, there will be GST. Whether it is full advance or partial advance. When GST will be paid is a separate question. Timing will be a separate question. But there will be GST on the entire building portion. Value will be the same. Timing may be different. But what about the third case? The third case, it is not construction of building, it is sale of, because the building was ready. There was completion certificate given or first occupancy was there, whichever is earlier, which means the building was ready. The payment was made after that. It is not construction of building, it is sale of building. There won't be any GST. And by the way, when you talk about construction or works contract, it is supply of, that will be given in your schedule 2. Supply of services. That's all about this land and building. We are connected schedule 3 also along with schedule 2. Whether it is supply of goods or supply of, this will be said by your schedule 2. Supply of service. Land and building. Sale of land is always outside GST. Building, if it is construction of building, when advance is given, supply of service. If it is sale of building, which means entire payment was given after completion certificate of first occupancy. It is sale of building outside the ambit of GST. Next, you are talking about actionable claim. This you have already completed. Actionable claim is outside the ambit of GST. Other than betting, gambling, lottery, that will attract GST. Now the last two paras are related to customs. You have to read in this way. First 6 and last 2. 6 plus 2. Drop shipment. What is drop shipment? What is drop shipment? Para 7. Directly from outside India, the goods are going outside India. Directly from outside India. You are in India. You purchase from Australia. You purchase from Germany and you sell it to Sri Lanka. You are purchasing from Germany, but you are selling to. But what is happening? The goods are directly going to Sri Lanka. Movement is directly there. Movement. Accounting transaction is different. Accounting transaction is purchase and sale. This is your purchase and this is your sale. But movement is directly there. This is called as drop shipment or merchant trading. This will not even attract. This will not attract anything. On purchase, there is no import duty. On sale, there is no GST. Nothing. If I am doing this transaction on my purchase from Germany, no import duty, no customs duty. On my sale from India to Sri Lanka, no GST. Why? Indirect tax is always destination based tax. Finally, the goods are going where? Sri Lanka. Which government has got the right to collect tax on these goods? Sri Lanka. India has got nothing to do with it. Why will India play this game? Pay amount, then take the refund. Unnecessary waste of time both for the government as well as for the assessee. Don't pay anything. On my purchase, no customs duty. On my sale, no GST. Nothing. It is a tax-free transaction. It is a tax-free transaction. This is called as drop shipment or merchant trading. That is para 7. So then what is para 8? Para 8 is a bit different. The goods will be cleared in India, which means import duty will be paid in India. Import duty will be paid in India. The goods will be cleared in India. Import duty will be paid in India. But what is happening is, I am purchasing the goods in India. I am the importer. But I am giving the goods to another company. I am giving the goods to another company. So there is a purchase from, there is an import from Germany. There is a very clear-cut import from Germany. But there are two different scenarios. One scenario, the goods are in custom station and at that point of time, there is a transfer of title. There is a transfer of title between VJ Limited and PJ Limited. I am selling the goods to PJ Limited. Second scenario, the goods initially went to custom station, then the goods went to customs warehouse. When the goods were in customs warehouse, there was a transfer of title from VJ Limited to PJ Limited. That is a transfer of title, which means I have sold the goods. I have sold the goods. Who actually imported the goods? Actual importation initially was done by VJ Limited. Who is going to clear the goods? So, if at all you think in that way, the importation initially was done by VJ Limited, but the clearance will be done by PJ Limited. Now, think of this. VJ Limited would have paid something to the Germany exporter. Correct? I purchased and I sold. VJ Limited purchased from Germany and sold to a customer in India. Both are in India. So I would have purchased. Only think of VJ Limited and think of the transaction. On my purchases, I would have initially purchased the goods and then I am selling the goods. Supposing I have purchased for 1 crore, I am selling for 1.2 crores. 1.2 crores. The entire focus is on VJ Limited. VJ Limited will not pay import duty on 1 crore. VJ Limited will not pay GST on 1.2 crores. There's no import duty. If you see Customs Act will tell import duty will be paid by PJ Limited. So VJ Limited is again tax-free entity. It does not pay any import duty on its purchase. It will not pay any GST on its sales, whether it is high C sales or whether it is sale of warehouse goods. Conceptually, they are different, but the tax treatment is the same. VJ Limited will not pay any import duty on its purchase 1 crore. VJ Limited will not pay any GST on its sale 1.2 crores. It will not pay any taxes. It will not pay any. Then what will happen? Finally, when PJ Limited is going to clear the goods, PJ Limited will finally pay import duty as per your Customs Act. So if you look from angle of this para 8 is from the angle of VJ Limited, and para 8 only talks about GST. It does not talk about import duty. From where I got that it is not going to pay import duty? From Customs Act. That VJ Limited will not pay import duty because Customs Act tells that the person who's clearing the goods is the importer. So PJ Limited will pay the import duty. Now let us consolidate all the concepts of your customs and GST. This is the final picture. What is the final picture? With respect to VJ Limited will not pay import duty, will not pay GST. Import duty on its purchase, GST on its sales. Who will finally pay? It is PJ Limited which will finally pay import duty on its purchase as per your Customs Act. Right. So that is all about your para 8. Schedule 3, 8 para. 6 plus 2. 6 plus 2. So are you guys clear with this? Schedule 3, 8 para. Read it as 6 plus 2. And there are notified cases. Read this notified cases as 1 plus 2. Read this notified cases as 1 plus 2. Again, split it up and try to read it. What is the first point? The first point is a relief from a difficulty faced by transportation sector. A relief. We have discussed that if the movement of goods is there from one distinct person to another distinct person, it is deemed supply as per para 2 schedule 1. Supply between distinct person is the supply of goods associated between distinct person is deemed supply. But the problem is, if you're talking about VRL logistics for goods transportation sector or KPN travels for passenger transportation sectors, they will have branches in different states. And if their trucks or buses move from one state to another state, they are required to pay GST on what? Their trucks and buses. Don't stop here. Think of airline. If Indigo airline moves from Coimbatore to Mumbai via Bangalore, so Coimbatore to Bangalore, Bangalore to Mumbai, they are having branches in all these states. So it will be treated as deemed supply, which will make their life difficult, rather I'll use the term impossible to survive. Right, therefore they give a relaxation. Okay. If at all you're talking about movement of any kinds of conveyance, be it bus, be it truck, be it a van, be it a car, be it a helicopter, be it a aeroplane, be it a rail, there is no deemed supply. This is giving relaxation from where? This is giving relaxation from deemed supply para 2 schedule 1. This has to be read along with para 2 schedule 1. Para 2 schedule 1. So now if a bus or a truck is moving from Tamil Nadu to Karnataka, say between Tamil Nadu VRL Logistics to Karnataka VRL Logistics truck movement, or Tamil Nadu KPN travels to Karnataka KPN travels, they are talking about movement of bus, then it is not a supply. Then it is not a supply. Movement of any conveyance including not only the trucks but also rigs, tools and spares thereof. Also machinery like tower cranes, concrete mixtures not mounted on wheels, special machines. They are telling that this will go and come back. The logic is pretty simple. That bus or truck, including spares on it, including special machineries, will go to that place and come back. Will go to that place and so you cannot ask them to pay output tax, take input tax credit there, again pay output tax there, take input tax credit again here. That is not fair. Therefore, it is not at all supply. Therefore, it is not at all supply. Not only the conveyance, but also the tools and spares on it, also the special machineries. They have given relaxation. Very simple understanding. It will go, come back. It will go, come back. It will go, come back. It is not going there permanently. And this is the business nature is such that it will happen regularly. So that's a relaxation from that. That's a relaxation from where? This relaxation is only from para 2 schedule 1. So here you have to recollect or you have to write para 2 relaxation from para 2 schedule 1. Para 2 but one important point, and which is very quite logical. They want relaxation from deemed supply, not from actual supply. If the bus and truck is finally sold, if the bus and truck is finally sold, pay GST. Correct? If the bus or truck is finally sold, please pay GST, actual supply. If there is repair and maintenance of the bus and truck, there is actual supply. Consideration is involved. Pay GST. See, both these points which I have highlighted in orange color, there is actual supply. There is sale of bus or truck. Pay GST. There is repair and maintenance of the bus or truck. Pay GST. That is actual supply. There is actual supply. In both these cases, there is actual supply. Relaxation is not from actual supply. Relaxation is only from deemed supply. Actual supply, please pay GST. You have to pay GST. Are you guys clear with this understanding? Can Reliance Limited carry its own goods in its own truck? Yes or no? Yes or no? What will happen in that case? It is not necessary that you have to opt for the services of VRL Logistics. You cannot have your own buses. What will happen in that case? What will happen in that case? Reliance Limited, Maharashtra, is taking the goods to Reliance Limited, Delhi, in its own truck. In its own truck. What is the answer? So there is a truck belonging to Reliance Limited. There are goods inside the truck and there are spares. So there is a truck, there is goods inside the truck, there is spares. What will happen? For the goods portion, it is deemed supply para 2 schedule 1. You have to pay GST. No relaxation. The relaxation is only for the truck and spares. It is not supply. The relaxation is only for trucks and the spares. It is not supply. Right. So that is about your first notified case. Why I have said 1 plus 2? The second and third notified case only talks about government. When the transaction of government will never ever be subject to GST. Only talks about your government. If government is doing municipality related functions, Article 243G, or rather Panchayat related functions, Article 243G, or municipality related functions, Article 243W. Who is doing that function? Government, central government, state government, or local authority. If government is involved in municipality functions, Article 243W, Panchayat functions, Article 243G, not supply. Not supply. Or if government is involved by way of giving liquor license fees, is collecting liquor license fees. Which government is collecting it? State government. It is collecting liquor license fees, not any license fees. This clarification clearly tells that the focus is only on liquor license fees. Because liquor is kept outside GST, even keep the liquor license fees outside GST. Liquor license fees which is collected by state government outside GST. Any other license fees? Your spectrum license fees, 4G or 5G spectrum license fees, mining license fees, any other license fees, GST will be there. Liquor license fees by state government is outside GST. So there are three functions by government which are kept outside GST. Panchayat, Article 243G, municipality, Article 243W. These things can be done by central government, state government, or local authority. and liquor license fees collected by state government. These are the government activities which are outside any other activity of government. Is inside the ambit of GST. Levy is there. Collection may or may not be there. But levy is clearly there. Are you guys clear with this understanding? Not supply, 2 parts are over. There's a circular, very clear cut, simple circular. What is the circular trying to tell? Donations. Whether donations will attract GST or not. Donations. If there is no quid pro quo, pure donations, no GST. Pure donations, though the circular only talks about trust, charitable trust and all, but it is applicable for everyone. Pure donations, no GST. But if donation is given for an activity to be done by the opposite person, which means I am giving a donation to an organization, I am telling that put my name, put my company's name there in that event. Supposing there is a education exhibition in Kodisha and I am putting Vidyapeeth's name there. What will happen? Is it a donation? We may call it as donation in our books of account, but in reality it is not donation, it is advertisement. It is advertisement, subject to GST. Subject to, because there is a quid pro quo. For the amount that I am paying you, you are required to do something. But normal donation, for the amount that you are paying, opposite person is not required to do anything. You may tell that I am giving donation to temple, praying that this will happen, I will qualify CA in this attempt and all. But there is no contractual obligation. There is no contractual reciprocity. There is no contractual reciprocity for the amount that you have paid and the activity that is to be done. There is no contractual reciprocity. Therefore, pure donation outside the ambit of GST. So when you look at the term supply, we are done with the term supply, be it your actual supply, 2 parts, deemed supply, 2 parts, not supply, 2 parts. Now what is left out is your nature of supply, schedule 2. If you see your actual supply, there is no schedule. Deemed supply, there is schedule 1, supply without consideration. Not supply, there is schedule 3. If you see that, schedule 2 is missing. Schedule 2 does not talk about supply. Schedule 2 talks about supply of goods or supply of services. In fact, here you have to read it as not goods services, it is supply of. If you see the heading is supply of. So it is supply of goods or supply of services. We are not trying to understand goods or services. We are trying to understand whether it is supply of goods or supply of services. And this is quite simple. We'll quickly walk through it. I'll just ask you a question and you have to answer it. If I'm selling the goods, if I'm selling the motor vehicle, don't tell goods and service. If I'm selling the goods, it is supply of goods. If I'm giving the same motor vehicle, if I'm selling the motor vehicle, supply of goods. If I'm giving the same motor vehicle on rent or license or lease, supply of services. Supply of, because I'm just giving the right to use the goods without transfer of title. This point, para 1C is again repeated. Is again repeated in 5F. That's a repetition. That's a repetition. That is transfer of right to use. Transfer of right to use the goods. There's no transfer of title. That's the repetition. When I'm just transferring the right without transfer of title, it's supply of service. Next, if I give the motor vehicle on hire purchase. Hire purchase. If I give the motor vehicle on hire purchase where title will be transferred at a future date, it is supply of goods. The supply of goods. So this area is an interesting area where hire purchase, initially ownership is not given, only at the time of last installment it is given, but still it is treated as supply of goods right from first installment. Right from first installment, supply of goods. If the installment is not paid, then there is a return, it is sale supply return. It is treated as supply of goods. Supply of goods. Then we are talking about land and building. Land and building. Please understand that if it is sale of land and building, not at all supply, we have discussed. If it is not sale of land and building, if it is renting of land and building, lease, tenancy, easement, including a long-term lease, where stamp duty is paid. Forget about stamp duty is paid or not. For GST, whether you have paid stamp duty or not is not relevant. In your accounting standard, how you are dealing with it is not relevant. You may call it as financial lease, and you may tell that no, in substance, the owner is the lessee, not relevant. Your accounts is not relevant. Your stamp duty loss is not relevant. Is it lease? Whether ownership is transferred. If ownership is not transferred, it is supply of service. It might be a case where the lease is of say 99 years. 999 years. Where generations will come. And clearly your accounts will tell that it is financial lease. Which means lessor is not the real owner, it is the lessee. Forget about your accounts. Forget about your stamp duty laws where they'll tell that it is very similar to sale. You're trying to route it as lease, but it is equal to you pay. Forget about that. For GST, it will be lease. Supply of service. Supply of why? If you treat it as sale, it becomes sale of land and building, which is covered in Schedule 3, which is not a. So government is very clear. Government is, I want GST. So what you are doing in your accounts and what you are doing in your stamp duty laws, I am not bothered. You pay GST. Land and building. The same thing, para 2 is again repeated where you are talking about 5A, renting of, same thing, supply of service. Supply of service. The same thing is again repeated there. Next, you are talking about job worker. Any industry will have job worker. Take any industry across the world, there will be job working. There will be job working, which means you are working on the goods belonging to another person. Treatment or process applied on goods belonging to another person. Job work. Simple thing, you are talking about a job worker. Supply of goods or supply of service? Supply of goods or supply of service? Supply of service. Supply of service. Clear? That is your para 3. Now para 4 will take in the end. Para 5. Let us see the leftover points of para 5. Para 5 talks about your construction. Construction means advance was given, whether full advance or partial advance. You are not talking about a case. You are not talking about the exception where the entire consideration was given after. If that is the case, it is sale of building, not supply. You are talking about construction, which means partial advance or full advance. It is supply of service. It can be either a pure construction or it can be a case where there is works contract. Where there is, which means it involves goods plus service. Either I could have constructed this building by giving a pure labor contract to the builder. I'll tell that I'll be giving the materials, be it cement, sand, steel, etc., etc. Construction, supply of service, or works contract. I may tell the builder I am not going to involve in any of these. You purchase cement, sand, steel, iron, etc., etc., and you give me this building ready. It is a works contract. It is a works. Even that is supply of service. Even that happens to be supply of service. Though it involves both goods and services, though the value of the goods may be higher than the value of the, but what is the real intention? I went to that builder for the goods or for his services. What was the dominant element? Not in terms of value, but in terms of the intent of the contract. The intent of the contract was to get his service. So it is supply of service. It is supply of service. Clear? Pure construction service, supply of service. Goods plus service, supply of service. This works contract is always related to immovable property. So either it is civil structure or plant and machinery. It can be even plant and machinery. I purchase plant and machinery. That is supply of goods. But for installing that plant and machinery, cement, sand, steel will be required. If you see big plant and machineries, you require installation. For installation of that plant and machinery, I will require cement, sand, steel, etc. plus labor. We are talking about that installation. What is that installation of plant and machinery? Supply of? It involves both goods and we are not talking about purchase of plant and machinery. Purchase of plant and machinery is supply of goods. We are not talking about it. We are talking about the installation portion. Supply of service. Works contract. Right. Then, if you see, there's a point which is discussed here, which you have already covered. Refraining from an activity, tolerating an activity. Consideration can be for doing an activity or not doing an. What is that not doing an activity? Supply of services. Supply of services. Right. Then the last two leftover points talks about your IPR and ITS. Intellectual property rights and information technology software. Make one thing very clear. Be it IPR or be it ITS. They are goods. The product is goods. They are movable. But we are not talking about goods or services. We are trying to understand whether it is supply of goods or supply of service. See, motor vehicle is goods. If you sell the motor vehicle, it is supply of goods. If you rent the motor vehicle, it is supply of. So just like that, software and IPR is goods. If I permanently sell the software or permanently give up my IPR, supply of goods. But if it is temporary, how you find that it is temporary? Look at the language of IPR. Temporary transfer or permitting the use or enjoyment of IPR. Temporary transfer or permitting the use or enjoyment of IPR. Sony Music giving the IPR to JioSaavn for playing the music on its software. Is it permanent transfer or temporary transfer of IPR? Temporary transfer. Supply of services. But if I have invented a formula for a medicine and pharmaceutical company is taking that formula, I have to give the entire ownership to the pharmaceutical company. They will not allow me to use that formula anymore throughout my lifetime. I should not even disclose it. NDA will be signed. Right, I cannot even disclose it. Now what is that? Supply of goods. Why? It is not temporary transfer, it is permanent transfer. Same way, when you talk about software, adaptation, development, design, customization, programming, upgradation, implementation, enhancement. All these terms includes everything but not sale. But not sale. It is supply of service. But if it is sale of software, but if it is classic example, your WhatsApp was sold to Facebook, now called as Meta. That was supply of goods. Your Instagram was sold to Facebook, now called as Meta. That was supply of goods. Because ownership was given. Entire ownership was given. And you using all the apps on your phone, they are supply of services. They are supply of services. Right? Because you don't get the ownership. Are you guys clear with this understanding? So IPR and ITS are always goods. But the transaction majorly are supply of services. When it is supply of goods? When there is a permanent transfer of IPR or permanent transfer of ITS, then it is supply of goods. Otherwise, it is supply of services. And finally, when you see 6B, food sector, we talk about food sector, there are only two possibilities. One is restaurant and one is outdoor catering. Obviously, liquor will be removed here because liquor does not attract. Whether it is restaurant sector or outdoor catering, both involves goods plus services. Both involves goods plus. But what is the dominant element? Dominant element. Why are you ready to pay 30 rupees for a idli where you can get that same idli for 3 rupees at your home? Service. Service element. Service element. So supply of service. Supply of, be it restaurant or be it outdoor catering. Outdoor catering involves more of service because they are going to come to your place and offer you that. But both, what is the dominant nature in both? It is service. Supply of services. So that's all about para 1, 2, 3, 5, 6. Para 4, always remember that. Read it along with schedule 1. Schedule 1 read along with. If you read it along with schedule 1, life is very simple even in para 4. What is para 4 talking about? Para 4. See para 4a, what it is talking about? It is talking about a scenario where you are talking about business assets are transferred or disposed of. Similar kind of wordings you have seen in schedule 1. Permanent transfer or disposal of business assets on which ITC is available. If it is supply, which supply it is? If Tata Limited is giving gifts of free samples on which it is ITC is available, it is deemed supply. Now, deemed supply of what? Deemed supply of what? Goods. Deemed supply of what? It is deemed supply of goods. Sir, what if Tata Limited has not availed ITC? Not supply. If it is not supply, don't see here. If it is not supply, don't waste your time in schedule 2. Don't waste your time in schedule 2. Clear? Clear? I am taking both the examples. Tata Limited giving gifts of free samples. It has availed ITC. Schedule 1 tells it is deemed supply. Schedule 2 tells it is supply of goods. If Tata Limited did not avail ITC and gave the gifts, not supply, forget about supply of goods or supply of goods. It's not at all relevant question. Likewise, if at all goods are held for business purposes but are put to private use or for non-business purposes, which means private use, again same meaning. Which means if company's assets are used by director for personal purposes, Kingfisher Limited assets, say aircraft or cruise is used by Vijay Mallya for personal use. For personal use. Is it supply first of all? Yes. Employer-employee. Any transaction between employer-employee is a related party transaction. Again covered in para 2. Supply of goods or services between related person or distinct person is deemed supply. It is deemed supply. It is deemed supply. What will happen? What will happen? It is deemed supply because of para 2 schedule 1. It is deemed supply because of schedule 1. Now if it is deemed supply, what is the supply? Why? Vijay Mallya will use the cruise of Kingfisher Limited for some time, again it will give back to Kingfisher Limited. Title is not transferred. Title is not. If title is not transferred, it is supply of. Again here, let me change the example. ICI, if at all it wants to show the real intent, you can easily feel the heat in the exam hall. If at all the question is changed and it is said that Kingfisher Limited is giving the cruise to Mr. Mukesh Ambani, one of the esteemed customer of Kingfisher Limited for private use of Mukesh Ambani. It's not at all a supply. Why? There is no relationship between Kingfisher Limited and Mukesh Ambani. If there is no relationship, it cannot be covered by para 2 of schedule 1, which means it is neither actual supply nor it has given free. See, Kingfisher Limited tells that you are our esteemed customer. And in the conversation, it was said by Mukesh Ambani that my cruise is not working now, fine, and I want to go for a tour. Therefore, the MD of Kingfisher Limited said that don't worry, you take my cruise. Mukesh Ambani said, no, I don't want it. He said, no, don't worry, take my cruise. Don't worry, you take it. Was it for business purposes? No. It was clearly for private use. It was clearly for private use or non-business purposes. If you see at schedule 2, you might be confused. But what is the sequence? First see schedule 1. Is it deemed supply? No. Why? Now the transaction is between Kingfisher Limited and Mukesh Ambani, not even Reliance Limited. Kingfisher Limited and there is no relationship. Therefore, it is not deemed supply. If it is not deemed supply, forget about supply of goods or supply of services. Clear? You have to, first thing that I said is, it has to be read along with, you cannot read it in isolation. If you read it in isolation, you will make mistakes. Because if I read this in isolation, it will be looking as if it is supply of services, which is not the reality. And finally, where a person ceases to be a taxable person. Which means, if I tell that, I am cancelling my registration. I was liable for registration. Now I am not liable. I am cancelling my registration. I am ceasing to be a taxable person. VJ Limited registered is different from VJ Limited unregistered. Both are distinct person. VJ Limited registered is different from VJ Limited unregistered. So is it deemed supply? I'll have some stock of goods. I'll have some stock of goods. Is it deemed supply? Yes. How? Again, para 2 schedule 1. Supply of goods or services between distinct person. VJ Limited registered is different from VJ Limited. VJ Limited registered is different from VJ Limited unregistered. It is different from VJ Limited unregistered. Therefore, that is deemed supply. Now, what is the supply? What is that supply? I'll have some stock of goods. I'll have some stock of, whenever a business is stopping, normally there will be some stock which is left over, on which I have availed ITC. On which I have availed ITC. Even if you see para 1, there is permanent transfer or disposal of business assets on which ITC is availed. Even by both the paras I am hit. So I have to pay output tax. Now that stock will be what? Goods or services? Goods. So supply of goods. It is supply of goods. VJ Limited registered is different from VJ Limited. If you understand this, everything is clear. It is deemed supply in terms of both para 1 as well as para 2. Therefore, it is deemed supply. Now, what is the kind of supply? Supply of goods. Supply of goods. So, but there is an exception given here. What is that exception given here? If at all business is sold as a going concern to a legal representative or to a third person, anyone, either to my legal representative or to my third person. If business is sold as a going concern, then it is treated as supply of services, which is fully exempt. If I am selling my business as a whole to a third person, see, one thing is I am stopping my business. Stopping my business is covered in the first part we have discussed. I am stopping my business, at the same time the entire business is sold to the next person. Who is that next person? Either my legal representative, like my son or my daughter, or third person, can be anyone. Now, sale of business is not called as sale of goods, because sale of business will have an overvaluation. If at all you are clear with your financial management, you will know that the valuation is not of the business per se, the goods per se. It will be of the future earnings, right? That is supply of service. Supply of service. But that entire supply of service is exempted when you see your exemption notification 12/2017, CT rate read along with 9/2017, IT rate. It is fully exempted. It is supply of service. First, understand that it is not supply of goods. It is supply of. Second, understand that it is fully exempted. It is fully exempted. If you see your exemption notification, sale of business as going concern, either whole business or even part of the business. I may be into 4 separate verticals. I am selling only one vertical. Even that sale of one vertical of my business is exempted. First thing, it is not sale, supply of goods, it is supply of. Keep this in your mind. Sale of business is not sale of goods, it is supply of services, but fully it is exempted. Whether my business is sold on a whole or part, it is supply of service and it is exempted. It is exempted. That's all about your schedule 2. Now, if you look at your supply entire chapter, you will find that we are done with your entire chapter and we are done with your entire supply. All you have to remember is the flow. Actual supply 2 parts, go with it. Then deemed supply 2 parts, then not supply 2 parts. Once you are clear with that, then go on to your schedule 2, whether it is supply of goods or supply of services. But don't forget that you are going to see schedule 2 only once it is supply. If it is not at all supply, there is no use of seeing schedule 2. Only if it is supply, you have to decide whether it is supply of goods or supply of. Even there was a confusion in the beginning. Finally, there was an explanation attached and said that when you are seeing schedule 2, it should be a supply. Schedule 2 will not decide it is supply. Schedule 2 will tell it is supply of goods or supply of services after you have decided that it is. So schedule 2 will not answer the question, is it supply? It will answer whether it is supply of goods or supply of services after you have answered the first question, that whether it is supply. So when we saw the bird's eye view of supply, it was said that first read it as supply, then go to nature of supply. First understand what is supply, then go to the nature of supply. That's all about your third P, which was your process supply. So moving on to your term composite supply and mixed supply, which again is discussed in your section 8. Obviously, this time it is not only section 8. Section 8 read along with section 2. What is composite supply and what is mixed supply is given in section 2. What is the tax treatment of composite supply and mixed supply is given in section 8. So it is section 8 read along with section 2. Section 8 read along with your section 2. Now when you talk about your composite supply and your mixed supply, one thing is very clear. There are 2 or more supplies. There are 2 or more supplies. What is the sequence? Directly let us focus on the conclusion. What is the sequence? First you have to evaluate whether it is a composite supply. If not, then evaluate whether it is a. So what should be the sequence? First evaluate whether it is a composite supply. Then evaluate whether it is a mixed supply. In composite supply, there are two or more taxable supply. Two or more. In mixed supply, there are two or more individual supply. They by default they cannot be clubbed. By default they cannot be clubbed. By force they are clubbed. Rather, one way answer of composite supply can be natural bundling, and mixed supply can be artificial bundling, which is the next point, by the way. What is the type of bundling? In composite supply, natural bundling. In mixed supply, it is artificial bundling. Artificial. So first you have to check whether it is composite supply, then evaluate whether it is a mixed supply. For composite supply, there should be two or more taxable supply. For mixed supply, two or more individual supply. For composite supply, they should be bundled in ordinary course of business. Ordinary, though nothing is said in mixed supply, it is implied that they are not bundled in ordinary course of business. That is artificial bundling. You will not find the term artificial bundling there, but it is implied that they have said one thing: it should not be a composite supply. When they have said it should not be a composite supply, it should not be natural bundling, it should be artificial bundling. It should be artificial bundling. Then in your composite supply, they don't talk about pricing, but in your mixed supply, they tell that there should be a single price. For all the items supplies together, there should be a. In case of composite supply, the price can be single or multiple. I can have one price or I can have split up a pricing system. I can split my price. But in case of mixed supply, I cannot split my price. I should show only one price. I should show only consolidated price. I cannot go for split up pricing system. I have to go for consolidated pricing system. Is it mentioned anywhere in composite supply? No. But it is implied. In mixed supply, they focus that pricing should be single. Whereas in composite supply, they don't talk about it, which means it can be single or it can be split up multiple. And in composite supply, there will be one supply which is a principal supply. The main hero, the main character, the lead character. All other will be side actors. One will be principal supply, the main actor. All others will be side actors. Principal supply. What is meant by principal supply? Principal supply is a supply which constitutes the predominant element of composite supply, and other supply forming part of that is ancillary. Lead hero. Principal supply will have the predominant element, the main element of composite supply, and all the other supplies will be ancillary. Side actors will be ancillary. Now in mixed supply, you are talking about a movie which is having multiple heroes, and you cannot tell that this is the main hero. All of them will have equally good roles, lead characters. Lot of movies are there which is having multiple lead characters. They will go under the character of mixed supply. Mixed supply. So when you talk about mixed, say for example, if SSR decides to make Mahabharata, right? Rajamouli sir decides to make Mahabharata in 10 parts. Right? That is the discussion going on for ages. That he is going to make a movie on Mahabharata, not in part 1, part 2. It will be in 10 parts. Can you name one character as a lead character? Will it be Lord Krishna? Will it be Arjuna? Will it be Dronacharya? Will it be Karna? Will it be Duryodhan from his point of view? So there you are talking about the concept of mixed supply. So there is no concept of principal supply. It cannot be there. There is no lead character. There is no. All of them are equally good. Look at the second difference. Two or more individual supply. No one will allow that he is the main character. Individual supplies are there. So here there is no concept of principal supply. There is no concept of principal supply. This is the definition of your. This is the definition of your composite supply and mixed supply. Second part, tax treatment. In case of composite supply, the tax treatment will be based on that of principal supply. The principal supply is having 12%, it will be 12% for the entire supply. If the principal supply is having 18%, it will be 18% for the entire supply. If the principal supply is having 28%, it will be 28% for the entire supply. If the principal supply is exempt, entire supply is exempt. Entire supply is exempt. Fully it is exempt. Education is a classic example. The principal supply, education and schools or colleges is exempt. Other supplies, be it your stay facility, right? Or be it your hostel facility or be it your mess facility, food, it's exempt. It depends on principal supply. Whereas in mixed supply, it will be that of highest rate of tax, which means if at all there are 4 supplies in mixed supply having 5, 12, 18 and 0. 5, 12, 18 and 0. What will be the rate of tax on the entire value? 18. If it is 5, 12, 28 and 28 plus cess, for the entire value it will be 28 plus cess. This is as good as that. When you're watching a movie with multiple lead actors, who will be finally taking the credit of the audience? Where the performance was the best, highest. You're talking about the highest liability. So when you come out of a movie, obviously you'll be focusing on one character. Though it will be a movie with multiple actors. Let us take a classic example of Vijay Sethupathi acting in a lot of movies with multiple actors. But finally when the audience comes out, they forget the other actors. They focus only on. So we are talking about highest liability, which has taken the great effort. So if it is 5, 12, 18, 18. 5, 12, 18, 20, 28%. 0, 5, 12, 12%. 0 and 5, 5%. 0 and 28, 28. Highest liability. It's highest does not mean 28. Amongst that, what is the highest rate of tax? Right. Classic example of composite supply. What can be the classic examples of composite supply? Education with hostel mess, your classroom coaching with textbook. Right, lot of examples. Your travel with food, your accommodation in a hotel with free food, free breakfast. Right, you'll have your main thing, your selling of goods with transportation and insurance. Sale of goods with transportation and it's all naturally, it is normally asked. So how to decide whether it is natural bundling or artificial bundling? Mainly it is decided by the normal industry practice and the perception of the customer. There is no straight jacket formula. There is no straight jacket formula. It will be dependent on the industry. That what is natural bundling and what is artificial bundling. If in an industry, it is a very normal practice to have education with hostel, then it is natural bundling. If in an industry, it is not normal to have a particular activity. Say for example, paste with brush. A paste is given along with brush free. Though you may think it is composite, but in reality it is not composite. It is mixed. Why? It is not the normal industry practice to give a paste along with brush. It may be for some time by some companies, but not by majority of the companies. It depends on the perception of the customer, mainly the normal industry practice. Majority of the suppliers, what are they doing? That will decide whether it is natural bundling or not. Other things would be the nature of supply, whether you are packaging as a single price, how you are advertising. That will be the other factors, but they are not the main factors. Main factor is what the majority of suppliers are doing in that industry and what is the expectation of the customers from that industry. That will decide whether it is natural bundling, composite supply or artificial bundling, mixed supply. That will be the deciding criteria. Are you guys clear with this understanding? So the meaning of your composite supply and mixed supply along with the tax treatment, along with the example. So if I tell you an example of book and a pen, mixed supply. That is a mixed supply. Any combo pack, if you go to say Big Bazaar or say Reliance Trend, any combo pack, Big Bazaar is a classic example. You get a lot of combo supplies. You get a washing machine with a phone free. They're all combo packs. They're all combo packs. Not naturally bundled. They are all examples of mixed supply. Can there be two or more supplies where it is neither composite nor mixed? Yes. The same, take the example of say Big Bazaar, where you are purchasing multiple items and for each of the item there is a separate pricing. It is not composite because it is not naturally bundled. It is not mixed because the pricing is not single. The pricing is multiple. First item, separate price. Second item, separate price. Third item, separate price. So what will be the tax treatment? Respective item, respective rate. Respective item, respective rate. So it is neither composite nor mixed. Why it is not composite? Not naturally bundled. Why it is not mixed? There is no single pricing. Separate pricing. Separate pricing. A few circulars. Printing of book. What it is? There is printing plus there is paper. What is the principal supply? Printing or paper? Printing or paper? Printing. That is the principal supply. Paper is ancillary. But same way, if I purchase greeting card and I ask the shop owner to write a customized quote. That's a greeting card. That's a customized quote that I'm asking you to write. Asking the shop owner to write. Now what it is? What is the principal supply? Greeting card, paper. Printing is now ancillary. Printing is now. So if I'm giving this book for printer to the printer for printing, then it is supply of service. Why? Printing is principal supply, paper is ancillary. If I purchase greeting card which is ready made, it is already ready, and I am asking for a customized quote, customized printing, then it is supply of goods because paper is now principal supply, printing is ancillary. Servicing of car. If you go give your vehicle for repair, what it is? Not necessarily. They'll give you the breakup. If at all they have replaced your engine, separate price. Replace your tire, separate price. Then service element. There'll be breakup. Engine replacement, so much value. Tire replacement, so much value. General service, final value. So when you talk about engine and tire, there is separate pricing. It is neither composite nor mixed. Separate price, separate rate. But what about the general service? In that general service, they would have used, there is service and there is usage of goods also. Oil, grease, water wash, nuts and bolts, they are all goods. But what is the principal element? Service. So there it is service. So if I tell this example again, there is replacement of engine, replacement of tire and general service. Replacement of engine is a separate supply, neither composite nor mixed. Replacement of tire is a separate supply, neither composite nor. The service element is a composite supply where the principal supply is service. Water, oil, grease, nuts and bolts are all ancillary. Right, that is that. Now continue that example. Continue that example. That mechanic shop owner will have lot of old tires. He is giving those tires to third party for rethreading the tires. What it is? I am the mechanic shop owner. I am giving the tires to you for you to rethread the tires. Louder. Why? Job work. You are doing treatment or process on goods belonging to, it belongs to me, but you are doing treatment or process. You are a job worker. You are a job worker. Right. You will be having, what is the principal supply? Service. You will be using your goods also. You will be using rubber, sulfur, other items, but they are all ancillary. They are all, your major thing is service. I get back those rethreaded tires. I sell them. Supply of goods. Supply of, because now there is only one supply. There are not two or more supplies. There is only, okay, let me take that example of printing. I get the book from the printer. What it is? Supply of service. Printing is principal, paper is ancillary. Supply of service. I sell the book on my website. Supply of goods. I sell the book on my website along with classes. Composite supply. Principal supply is classes. Supply of service. Supply of service. Clear? You keep changing the answers. And finally, when you're talking about your bus building. If at all I am the manufacturer of bus and I am building the bus on my own, right? That is a chassis which I have built and the body building is also done by me. There's no supply. I cannot supply to myself. I cannot supply to. Finally, when I am selling the bus, it is supply of goods. But if I have my chassis, the inner body, every vehicle will have a chassis number. I have my body. I give to third person for building the body. Now what it is? Louder. Why? You are doing treatment or process on goods belonging to supply of. In that process, you will be using the goods also. But still it is supply of service. Job worker. Job worker. Clear. Yoga camp along with stay. Yoga is exempt. What about stay? Why? Why? Is it composite supply or not? Yes. Yes. If at all 20-30 years back, I would have said that there is a camp along with stay. That would have been not so common. Not so common. Normally camps were only for one day where you can come, attend the camp and go. Stay and all, you have to take the headache. They will not take care of the headache of your stay. But now what is the culture? Whenever there is any camp, forget about yoga camp, any camp, summer camps. Right, any camp. There will be even accommodation facility. So it is now the expectation of the customer to have stay, and industry also have changed to that extent. Correct? Now it is composite supply, naturally bundled. Naturally bundled. What is the principal supply? Which is exempt. So entire supply is exempt. Are you guys clear with this understanding? Composite supply and your mixed supply. Your composite supply and your mixed supply. There's one circular which has been asked by ICA regularly. GTA charges, goods transportation agency charges. You're talking about transportation charges charged by them plus loading and unloading charges. If you see consignment note, you'll find transportation charges and loading and unloading charges. What is that? Composite supply. Composite supply. So whatever is the treatment of transportation charges, the same will be treatment of loading, unloading. Though there is another view which ICA gives both of you. In the answer, ICA will give you both of you, telling that transportation separate, loading, unloading is separate. So it is neither composite nor mixed. Why that another view is there? Because loading and unloading by default it is exempt. But if you club along with transportation, it becomes taxable. Right? What is the view that you have to take in exam? Go with the first view. It's very common practice. Along with transportation, there will be loading and unloading charges. If you understand in essence what is composite supply, you will not even buy the second view. Though ICA will write answer in both the views, you will not even buy the second view. You will go with the first view where transportation is there, along with that loading, unloading, coolie charges will be there. It is nothing but composite supply. It is nothing but composite supply. Now that is all about your composite supply and mixed supply. But when you have seen your composite supply and mixed supply, you would have seen the term two or more taxable supplies in your composite supply. Two or more taxable supply. Now what is a taxable supply? A taxable supply is that which attracts levy. Which attracts levy. That is levy. Then what is a non-taxable supply? What is a non-taxable supply? Non-taxable supply means there is no levy or no charge. No levy or no charge. So when you talk about your taxable supply, there is levy. Non-taxable supply, there is no levy. In your taxable supply, when levy is there may be collection, there may not be collection. Collection may be there, collection may not be there. Why collection is not there? Because the rate of tax is 0% or it is 100% exempted. Right. Now, there's something called as exempt supply. All the definitions, needless to say, I'm not going to repeat this again and again. Definition means you are going to see section 2 of CGST Act. Exempt supply. Exempt supply tells initially that exempt supply means you're talking about nil rated case, 0%, or it is 100% exemption, which means there is some rate That is the rate, say 18%. But if you satisfy a condition, it is fully exempted. The rate is there 18%. But if you satisfy the condition, it is fully exempted. Either by default, the rate itself is 0, or by default, there is some rate. But if you satisfy a particular condition of a notification, then it is fully exempted. Supposing I am dealing with an item. If I sell normally, it is 18%. But if I give to defense, then it is fully exempted. Then it is fully, right? You have to understand, sir, why not directly they have 0%? It cannot be. Because by default, they tell that when I am selling ready-made garments to normal public, it is 18%. But when I say I'll sell the uniforms to military, it is exempted with a condition. So fully exempted. It is having a rate, but if you satisfy a condition, it will be fully exempted. 100% exempted. 100% exempted. But exempt supply goes on to tell that exempt supply includes non-taxable supply. Non-taxable supply. If you look at this definition, it is very interesting. Taxable supply includes exempt supply. And exempt supply includes non-taxable supply. Non-taxable supply. Don't apply a mathematics. I've been telling this for long. Do not apply a mathematics here. Only remember this. Taxable supply includes exempt supply. Exempt supply includes. That's it. Don't tell that therefore taxable supply includes. No, this understanding should not be there. Though mathematically there's a problem, but intentionally that problem is created. Government wants this intentionally because everyone sitting here are aware, because they want the aggregate turnover to increase. They want the aggregate turnover to increase. Now basically what is non-taxable supply? Only two items. Alcoholic liquor for human consumption, fine notified petroleum products. If I am dealing with normal item and liquor and petroleum items, they want my turnover to include even the supply of liquor and supply of fine notified petroleum products, in spite of the fact that I am not going to pay GST on that. Right, that is the reason for including. Right, so the definition of taxable supply only tells this way. Taxable supply means there is a levy. Non-taxable supply stops here. There is no levy. That's the definition. The other part is an explanation. Exempt supply definition tells that exempt supply means it is 0%. Exempt supply means either it is 0% or 100% exempted. It includes non-taxable supply. Right. So if at all you understand this, taxable supply by default includes. Why? Because taxable supply includes levy but no collection, which is nothing but exempt supply. Which is nothing but exempt supply. Whereas exempt supply includes non-taxable supply. This is intentionally there, not by negligence. It is intentional, not by negligence. Why? That's a definition called as aggregate turnover. Aggregate turnover tells that it includes exempt. It does not talk about non-taxable supply. It includes. But when you see the definition of exempt supply includes non-taxable supply. So if I am dealing with an item having 18%, 0% alcoholic liquor for human consumption, 100 lakhs, 20 lakhs, 50 lakhs. What is my aggregate turnover? My aggregate turnover is 170 lakhs. My aggregate turnover is 170 lakhs. That is my aggregate turnover. Aggregate turnover clearly tells that it includes exempt supply, but exempt supply, when you see, it includes. Am I going to pay GST on 50 lakhs? No. Am I going to pay GST on 20 lakhs? No. One is non-taxable supply, one is exempt. I am not going to pay GST, but it is included in my aggregate turnover, and that will result into a lot of other things. It will impact my late fees, it will impact my annual return. It is going to impact a lot. It will impact my registration, it will impact my composition scheme. It's going to impact a lot of things in GST. Right. So that is the definition of your taxable supply, non-taxable supply, exempt supply, and I have said that this is only to make sure that your aggregate turnover is more. Your aggregate turnover is more, which in turn will affect a lot of things, including registration, composition scheme, late fees, annual return, your other things, GST annual return, a lot of other things. This is going to impact a lot of other things throughout your GST. because your aggregate turnover is so and so. That's the entire objective, right? This is all about your composite supply, mixed supply, read along with taxable supply, non-taxable supply and exempt supply. When you talk about your valuation chapter, the provision which is applicable is section 15. Rest all are rules. The provision which is applicable is section 15. So when you see the rules, section rule 27 to rule 31 is normal set of rules, normal valuation rules. Rule 31A and 32 are special valuation rules for special cases. 33, 34 and 35 are clarification to valuation rules. They don't give you valuation answer. They are clarifying certain aspects of your valuation. So the provision which is there is section 15, read along with valuation rules, which we have to split into three parts. Normal valuation rules, special valuation rules, clarifications to your valuation rules. Now when you talk about your section 15, the base provision is your valuation within section 15. You are not even going to go rules. If at all you have to get your valuation answer within section 15, you need to satisfy three criteria. The transaction should be between unrelated person, price should be the sole consideration, and it should not be a notified case. And it should not be a notified case. If it is a notified case, then you are going to go to the valuation rules. Notified supplies where rule 31A and rule 32 are applicable. If at all it is a notified case, you are shifted to your valuation, special valuation rules, rule 31A and rule 32. Now, if at all you satisfy these three criteria, unrelated person, price is the sole consideration, it is not a special case, it is not a notified case, then you are under section 15.1, 15.2, 15.3 itself. Selling price plus something minus something. Now, what is that selling price plus something and minus something? Basically, what is the base transaction value? Transaction value is selling price paid or payable. Selling price of service charges paid or payable. That's the starting part. Price paid or payable by the recipient. Price paid or payable by the recipient. Minus something. What is that minus something? Minus something is discount. Discount given before supply or at the time of supply. Discount given after supply. If it is discount given at the time of supply or before supply, you can directly deduct the discount and pay the tax. The only criteria is show the discount clearly on the invoice. Show the discount clearly on the, which means your transaction value is selling price less discount. Less discount. Any type of discount. Be it cash discount, trade discount, damage discount, quality discount, quantity discount, any type of discount. The question may give you different names. You can deduct that discount. But it should be actually discount and actually passed to the recipient. Right. But if it is discount given after supply, which means when you are selling it, that discount is not given. Discount will be given later on. Discount will be given later on. In that scenario, you can still deduct discount, which means you can still reverse output tax by satisfying three criteria. Agreement to give discount should be there at the time of supply. Promising to give discount should be there at the time of supply, not later on. Second, discount should be directly linked on relevant invoices, which means here you are going to go with tax invoice followed by credit note. Because on tax invoice it is price. Discount is given in a separate document, credit note. That credit note should be linked to invoices. And finally, the most important criteria. If supplier is reversing output tax, recipient should reverse proportionate ITC. If supplier is reversing output tax, recipient should reverse proportionate ITC. Supplier, you can reverse output tax proportionate to the extent of discount. But make sure that your recipient is reversing proportionate ITC. Tomorrow, if you reverse your output tax on the discount element, but your recipient has not reversed proportionate ITC, we will hold you responsible, we will be collecting tax from you. Simultaneously, they will be collecting from the recipient, that is a different story. But the obligation of the responsibility is on the supplier. Is on the supplier. If discount is there at the time of supply or before supply, there's only one document. tax invoice. If it is after supply, there is tax invoice followed by credit note. The amount of the tax invoice you will pay output tax, and the amount on the credit note, the GST amount on the credit note, you will reverse output tax. Net effect, it is on net selling price. Net effect, it is on net. If the selling price is 1 lakh and discount is 10,000, if discount is given at the time of supply, you are going to pay directly 90,000 multiplied by the rate of tax. If it is given later on, initially you will pay GST 1 lakh multiplied by the GST rate. Later on you will reverse GST on the discount element. Net effect is the same. Net effect is finally you are going to pay GST on 90,000, but conditions are different. If it is at the time of supply, only requirement is put it on invoice. If it is later on, make sure that agreement is there at the time of supply, credit note is linked to tax invoice, and you are reversing your output tax on discount element. Make sure that recipient reverses proportionate ITC. Proportionate, all these criteria should be satisfied. Right? So the focus is on net selling price. Selling price less discount. Selling price less. But one important criteria when you are talking about discount after supply is agreement should be there at the time of supply. For bad debts or compensation, agreement is not there at the time of supply. If the recipient is not making the payment and you settle for a lesser amount, the amount that he is not paying is not discount, it is compensation. If the recipient is not at all paying any amount, that is bad debts, that is not discount. So for that you cannot go with credit note. For that you cannot go with, right? If there is a long payment due from the customer, which is say 10 lakhs, but customer finally agrees to pay 7 lakhs, 3 lakhs cannot be called as discount. You cannot go with credit note. If the entire 10 lakhs is not paid, it cannot be called as discount. It is nothing but bad debts. On that, you cannot go with credit note. You cannot reverse your output tax. Now, this is a subtraction portion. Selling price minus discount. Two types of discount. Plus something. Now, the first plus something is nothing but your interest. We'll go with exactly opposite to discount is interest. Exactly opposite to discount is interest. So, plus interest or late fees or penalty for late payment of consideration. For late payment of consideration. So, if you're talking about interest or late fees or penalty for delayed payment of consideration, then you're going to add it. If the customer is paying you late, so if the due amount due was 1 lakh plus GST, if customer pays after the agreed time of 3 months, you're going to collect interest, late fees or penalty by whatever name you call. That amount will also attract GST. That amount will also attract GST. And in this case, it will be tax invoice followed by debit note. For interest on late payment, it will be debit note. Supplementary invoice. Supplementary invoice. Tax invoice followed by debit note. Now, one important thing that you'll understand in your time of supply chapter, you'll be taxing interest only when it is realized. If interest is not realized, there's no GST. Why? Time of supply for interest on late payment of consideration is only when you actually receive. So this point is because of time of supply, not because of valuation. Valuation tells that interest will be added to value, but time of supply tells that you will pay GST on interest on late payment only when it is. Supposing you are telling customer you have to pay 20,000 interest, but customer pays only 10,000. Finally, what you are going to add? Only 10,000. Only 10,000. Right. So that you have to remove. First addition is interest. Now, other additions. Second addition is taxes. All taxes other than GST will be added. All taxes other than GST will be added. For example, if it is tobacco, which attracts excise duty plus central excise duty plus GST, GST will be on selling price plus excise duty. For example, motor vehicle, which will have road tax as well as motor vehicle tax as well as GST. GST will be on price plus road tax plus motor vehicle tax. But this GST will not be on income tax TCS. Because income tax TCS, first of all, it is not indirect tax, it is direct tax. Secondly, it is not having the character of tax. Whenever you are collecting income tax TCS, that goes to opposite person's account, 26A's, which he is going to claim it as at par with advance tax. And if at all opposite person is not having any income tax liability, he'll get the refund. So first point, income tax TCS is not indirect tax. There itself, our understanding is very clear that this TCS will not be included. Secondly, it is not even a tax. If I am collecting income tax TCS from you under section 206C of your income tax act, that's not at all a tax. It is just like advance tax for you. And if at all you file your return of income without any tax liability, you will get the refund of that. So therefore, it is not added. All the indirect taxes are added. Make your life simple. All the indirect taxes are added. So GST will be on price plus all other indirect taxes. All other indirect taxes. That is the second addition. Now, third addition, which we have already discussed. First, we will see the points that we have already discussed. We took interest first because it was exactly opposite to discount. Second, non-GST taxes, because we have already discussed that when we have discussed your basics of GST. Third, subsidy. This also we have already discussed when you have taken your levy chapter, when we have discussed your term consideration. Consideration will not include subsidy from government. It will include subsidy from other than. So if at all there is subsidy, you will include it if at all it is from other than government. It should be received from other than government. Not to be received from government, from other than, plus one more criteria. It should be directly linked to the price. There are two criteria. One, it should be from other than government. Two, it should be directly linked to the price. If it is a general subsidy, you cannot add it. You don't know how much to add. If it is a subsidy related to each unit, each price, then you can add it. It can be a case where you are getting a subsidy from your holding company, but that subsidy is a general subsidy. Okay, for this year we are giving you 5 lakh subsidy. That 5 lakh subsidy is an ad hoc amount. It will remain the same irrespective of number of units that you are selling, which we call it as general subsidy. That will not be added. Why? It is not directly linked to the price. So what are the two criteria for adding subsidy? Other than government, that we already discussed, and directly linked to the price. Other than government and directly linked to the price. Then the fourth addition, recipient making the payment to third party on behalf of supplier. Recipient making the payment to the third party on behalf of supplier. So I can write in this way: recipient making the payment to third party on behalf of supplier. Recipient's payment to third party on behalf of supplier. If recipient has made any payment to third party on behalf of supplier, that is included in the price. Supposing I have entered into a contract where I have agreed that my charges will be 1 crore. Suddenly I have a due to be given to my vendor, 10 lakhs. And my vendor is going to my customer's place. I am doing subcontract. Supposing there is an event management work where I have a subcontract, I have a separate person for putting the tents. He is going to that event and putting the tents and suddenly asking the amount from my customer. Give me 10 lakhs. What will my customer do? He'll call me. And we have agreed for 1 crore. Now a third person suddenly is coming and asking 10 lakhs. What I'll tell? Don't worry. You make the payment of 10 lakhs to him. Finally, when you make me the payment, you make me payment only of 90 lakhs. Now GST is on 90 lakhs or 1 crore. It is on 90 lakhs, which is price paid or payable. The starting point is price paid or payable. Price paid or payable by the recipient is 90 lakhs plus 10 lakhs. Recipient to third party on behalf of supplier. So total it will be again on 1 crore. Though my customer will hand over 90 lakhs to me, but when I am going to give him invoice, I'll give invoice for 1 crore. And GST will be on 1 crore. and the payment that is paid to third party on behalf of the supplier will be adjusted by a journal entry. I have to pay to my third party and my customer has to pay to me 10 lakhs and my customer directly has made the payment of 10 lakhs to my third party vendor. So I'll pass a journal entry and close that. Right? We are talking about recipient making the payment to third party on behalf of supplier is very crucial. Now you may ask, sir, directly we were very clear the answer is 1 crore. Then why 90 lakhs plus 10 lakhs? Because the starting point of transaction value is price actually paid or payable. What is the price actually paid or payable by the recipient to the supplier? 90 lakhs. So therefore that 10 lakhs addition is important. Right. And the last addition, fifth addition, you're talking about incidental expenses. Incidental charges or expenses for any work done before or at the time of delivery of goods. Any work. It can be transportation, insurance, installation, erection, commissioning, warranty, guarantee, packing, special packing, protective packing, anything, commission, anything. The question can give you any of these words. Right, starting from your transportation, your insurance, your loading, your unloading, your handling charges, your warranty charges, guarantee charges, donation, dharmada. They can give you commission, they can give you erection, they can give you installation, they can give any such words, commissioning, any such words. But what is the criteria? It should be at the time or before delivery of goods. These charges are being charged. That will be added. This is miscellaneous addition. Miscellaneous addition. Criteria is these charges are at the time or before delivery. At the time or before delivery does not mean actual delivery, constructed delivery. If the projector is purchased and the projector person is charging for the projector and the installation of the projector. Constructed delivery is only when it's finally installed. So GST will be on what? Price of the projector plus installation charges. These are all these additions. That's everything about your transaction value. What you have to remember? Price or charges minus 2 types of discounts plus 5 additions. Interest, then non-GST taxes, all other indirect taxes other than GST, subsidy other than government directly linked to the price, recipient making payment to the third party on behalf of supplier, and finally incidental charges. Anything, miscellaneous addition, anything. Question will give you anything. There cannot be a valuation question without having incidental charges. You can have a lot of valuation questions where in some places they are not touched taxes element, in some places they have not touched subsidy element. But in all your valuation question, one thing will be very constant. There will be incidental charges. Right. Now few other special points. All these additions, that is price minus 2 deductions plus 5 additions. In all these 5 additions, you will directly add it. But when you talk about interest on late payment, supposing there is price of 1 lakh, incidental expenses of 10,000, interest on late payment which will be received later on by way of debit note, 20,000, and the GST rate is say 18%. What is the final transaction value? Transaction value, this is your selling price, this is incidental expenses, this is interest or late fees or penalty, whatever name you call, for delayed payment of consideration. One very important thing that you need to understand is this 1,10,000 will be added directly. But interest, this is ICA's understanding, not my understanding. I am very categorically clearly telling that this is ICA's point of view. You go with ICA's point of view. They will tell that this is inclusive of GST. So 20,000 multiplied by 100, because you are trying to find out the value, not the tax, divided by 100 plus 80. So final answer will be something lesser than 1,30,000. It will not be 1,30,000. It won't be 1,30,000. It will be something lesser than 1,30,000. So for interest, the amount is 1,26,940, rounding off to nearest rupee 1. For interest on late payment, always go with come tax calculation. For other points, normally normal calculation, but at times question will give you in that for all the items you have to go with come tax calculation. It will tell that price, all these points are inclusive of tax. Then you have to go with come tax calculation. But for interest, by default, always you have to go with come tax calculation. Come tax calculation. Clear? Now, there are certain circulars where I'll just tell the summary of the circulars. Interest on late payment should be to the supplier. Should be to the supplier. If it is to the supplier, then you cannot differentiate interest on loan and interest on late payment. I'll give you a very classic example. If Chennai Mobiles tells that I'll be supplying you mobile phones for 1 lakh rupees plus GST, and you can go for EMI from a banking company or a financial institution which is having a personal within Chennai Mobiles. Now there are two transactions. Chennai Mobiles to the customer, the banking sector to the customer. Right? Chennai Mobiles to the customer and banking sector to the customer. Now what will happen? Chennai Mobiles will pay GST on what? There are two transactions. One is Chennai Mobiles to the customer and your banking sector to the customer. Customer will get that 1 lakh plus GST from the bank or financial institution and give it to the Chennai Mobiles. Assuming that mobile phone cost was say 1 lakh plus GST at 18%. So customer will pay 1,18,000. The amount will be given by the bank. What is the value for Chennai Mobiles? 1 lakh. Now, what is the loan given by this value is for what? Sale of mobile phone, supply of goods. And what is the loan given by the bank? 1,18,000. What is the supply of service by bank? Interest element. Loan is mere transaction money. 1,18,000 will be given by the bank to the customer, and the repayment will be 1,18,000 plus interest on loan. Plus interest on loan. Correct. What is the supply of service element for the bank? Only the interest portion. Let us assume that interest works out to 10,000. Let us assume that is supply of services. Interest on loan is exempted. Interest on loan is exempted. Exemption notification. So what is the transaction value for the banking sector? Interest on loan 10,000. But the fact is interest on loan is exempted. Whereas mobile phone, in our example, we have taken the rate as 18%. 18%. If I just change this and tell that Chennai Mobile said that why should I have a bank or a financial institution in my premises? I'll do this financing on my own. I have a lot of funds. Why not open up another source of income? Chennai Mobile decides that it will act as the financier. It will act as the financier. So Chennai Mobiles to the customer, it is supplying the goods, supply of goods. Initially the amount was 1 lakh plus GST at 18%. Initially the transaction value for Chennai Mobiles was 1 lakh. Now the customer got the loan of 1,18,000, and when the customer is going to repay, it is going to give interest. It's going to give interest. Let us take the same value of interest as 10,000. Understand now, interest is given to the same supplier. This interest now cannot be called as interest on loan. It will be called as interest on delayed payment of consideration. Therefore, this will be added to the value. Obviously, when it is interest, ICA's understanding is it is inclusive of tax. It is inclusive of, for this time, Chennai Mobile's transaction value is not only 1 lakh, it is 1 lakh plus interest cum tax calculation. In the earlier case, this interest amount was in fact interest on loan because it was given by a third party. Now this interest amount is not interest on loan, it is interest on delayed payment of consideration because it is given by the supplier himself. Supplier, the same thing will be applied for a special agent. Same thing. Del credit agent. If del credit agent is a normal agent, then it is just like a bank or financial institution, exempt. If del credit agent is a special agent, now it itself is acting as supplier to the customer plus giving finance to the customer. So del credit agent will pay on price plus interest. If del credit agent is a normal agent, if del credit agent is a normal agent, it will just act as a third party. The transaction is between principal and customer. Del credit agent is a third party which will have only one source of income, which is interest on loan. It will get loan. It will make the payment to the principal on behalf of the customer, then recover from the customer with interest. It will act as a financial institution, right? Interest on loan. But if del credit agent is a special agent, the moment del credit agent is a special agent, the transaction is now between principal to del credit agent to the customer. And who is giving finance facility to customer? Same del credit agent. So del credit agent is a supplier to the customer, also financier to the customer. So the interest portion will not be interest on loan, it will be interest on delayed payment of consideration. Same logic will be applied, right? So that is all about your basics of valuation. Now moving on to your valuation rules. Now when are you going to go for valuation rules? When the conditions are not satisfied, you are going to go for valuation rules. When is rule 27, 28, 29 applicable? Rule 27 is applicable when there is non-monetary consideration, whether partly or fully. 28 is applicable when the transaction is between related person or distinct person other than principal agent. And 29 is when the transaction is between principal and agent. 27, 28, 29. 27, non-monetary consideration. 28, related party transaction, related person or distinct person. 29, principal agent. The moment you understand your 27, 28, 29 is automatic. Now what is 27? 27 tells that there is supply there, and the consideration that is paid by the recipient is either partly non-monetary or fully non-monetary, which means you are having difficulty in valuation. You go to valuation rule. In 27, there are 4 steps. First step, go with open market value. Now you may ask, what is this open market value? You see the definition of your open market value. Open market value is given here. Open market value is identical goods. Ditto, copy paste, everything is the same. In customs you have this term as identical goods. In GST you have called as open market value. Just recall, in customs it is identical goods. Here it is called as open market value. Ditto, open market value of a supply means full value in money excluding GST, because value excludes GST. It includes all other taxes other than GST, where the supplier and recipient are not related, because you are referring to other transaction. Please understand that in valuation rules you start referring to, for your answer you refer to other person. It's just like a case where you don't know the answer, you refer to the previous person. So you are referring to someone else. When you are referring to someone else, at least that someone else should be logical. Otherwise it doesn't make any sense. So you are referring to a transaction where the transaction between unrelated person, price is the sole consideration happening at or about the same time when your transaction happened. When that particular transaction happened. So you are referring to the value of identical goods or identical services. Technically it is, in GST it is called as open market value. Open market value. What if you fail to find open market value? So when it is possible? It is possible in cases where you are dealing with customized item, or you are dealing with that item for the very first time. Then your open market value is not possible. It's not possible. Then you go to the next step. Step number 2. what you do, you add monetary consideration plus money value of non-monetary consideration. Monetary consideration plus money value of non-monetary consideration. So supposing I have supplied you something and you have given me 1 lakh in money plus you have given me something in kind, say a laptop, a new laptop. So I'll take the value as 1 lakh plus monetary value of a laptop, monetary value of the laptop. Now if that laptop is new, I can easily find out the market value or the money value of the non-monetary consideration. I'll get the answer here. I'll get the answer here. But what if the laptop that you have given is a second-hand laptop? It's very difficult to find market value of the money value, monetary value of the non-monetary consideration. Then you resort to the third step. What is the third step? You refer to value of supply of goods or services of like kind and quality. LKQ. You refer to like kind and quality goods or services, which in customs language is nothing but similar goods. In customs language, it's nothing but what is value of like kind and quality. So when you're talking about supply of goods or services of like kind and quality, means any other supply. Obviously, when you're trying to value under valuation rules, you're trying to refer to some other value. So any other value of goods or services made under in customs, what is this LKQ called as? So made under similar circumstances where the characteristics, quality, quantity, functional components, materials, importantly even the reputation. Even the reputation is very important criteria. Other things might be satisfied in number of cases. Right, starting from your features, characteristics, quality, quantity, functional components, materials may match in other cases also. But what may not match is the reputation. Are same or closely or substantially resembling. Initially they start with same. Then slowly they come tell, okay, if it's not same, then don't worry. It should be closely or substantially resembling, which means they are focusing on identical or similar. Is the focus on exact same or somewhat similar? So here there are two indications to tell that this is nothing but similar goods of your customs. Similar goods of your customs. Right. So you refer to that. Finally, assume that you don't have identical goods or services. You don't have monetary value of non-monetary consideration. You don't have like kind and quality, which means you don't have OMV. You're not covered by step 2. You're not even covered by step 3. What is the last resort? Final resort. You take the amount that is received in money. In our example, take that 1 lakh and find the market value of non-monetary consideration. Till now, you'll say that step 2 and step 4 are the same. No. But now there is a difference. You're trying to find out the money value of non-monetary consideration taking the help of 30-31. Taking the help of rule 30-31. What is rule 30? 110% of cost. What is rule 31? Best judgment. Whatever value you're trying to figure it out. Roughly some value. You clearly find out that when you're going down the steps, the quality of the value decreases. The quality of the value, by default, the moment you enter into valuation rules, it is not accurate value, it is approximate value. As far as you are under section 15, it was accurate value. The moment you enter valuation rules, be it rule 27, 28, 29, 30, 31, your focus is shifting from accurate value to approximate value. In approximate value, in rule 27, step number 1 gives you more approximate value. The moment you come to step 2, step 3, step 4, the approximate value quality decreases. The quality of the approximate value decreases. What are the 4 steps? Step 1, OMV. 2, monetary consideration, market value of non-monetary consideration. 3, LKQ. 4, monetary consideration plus market value of the monetary value of non-monetary consideration based on rule 30-31. Right. These are the 4 steps. The moment you understand your rule 27, 28 and 29 are obvious. What is 28 when 28 is covered? Related party transaction or distinct person transaction. In that case, do one thing. Take the 4 steps of 27, remove the second step. So what will be the answer? Step 1. What is step 2? LKQ. What is step 3? 30, 31. Here there's no monetary plus non-monetary. Rule 30, 31. 30, 31. It's rule 30, 31. 4 steps of rule 27. Remove the second step. You will get the answer for rule 28. 3 steps of rule 28. Remove the second step. What is rule 29 by the way? Principal agent. Step 1. Remove the second step. Step 2. Rule 30. So if you take the 4 steps of rule 27, remove the second step, you will get rule 28. 3 steps of rule 28, remove step number 2, you will get rule 29. You will get rule 29. That's a very simple way to understand your 27, 28, 29. But wait. There are some special points in 28 and 29. Both in 28 as well as in 29, you have something called as optional valuation. This optional valuation is applicable only and only for 28 and 29. It's not applicable for 27. Which means in 28 and 29, either you go with the 3 steps or the 2 steps as given in 28, 29, or forget the 3 or the 2 steps respectively and go with optional valuation. What is optional valuation? Optional valuation is taking the next person's selling price, your second person's selling price, and multiplied by 90%. But there is a limitation for the optional valuation. What is the limitation? It is applicable only for goods. Second limitation, it is applicable only if the next person in line. If I am trying to find out my value, now I am going to find out my value based on the next person's selling price. So first, it is only applicable for goods. Second, the next person in line should be only a trader. The next person in line should be only a, you are trying to find out my value. I can be a manufacturer or trader, but the next person in line should be only a trader, not the supplier. You are not talking about the supplier. You are talking about the next person in line, which means customer of the supplier who's selling further. That person should be a trader. Now take his selling price multiplied by 90% and find the answer. Supposing you're talking about a related person. The supplier is selling to related person and related person is further selling to unrelated person. Or principal is selling to agent is further selling to unrelated person. By the way, agent here we are talking about is normal agent or special agent. The agent here discussed in your rule 29, the focus is on normal agent or special agent. We are trying to talk about special agent. For normal agent, all these difficulties are not at all there. For normal agent, the transaction is between agent to principal, commission, principal to customer, selling price. This difficulty does not comes. When the difficulty comes, special agent, principal to special agent. There is no actual supply. There is there this application will come. The agent that is focused here is not a normal agent. The focus is on special agent as per your schedule 1, where the deemed supply concept hits in. For a normal agent, you will never enter valuation rule. Agent to principal, commission, everything is satisfied. Unrelated person, price is a sole consideration, not a special case. Transaction value, principal to customer, everything is satisfied. Unrelated person, price is a sole consideration, not a special case. You will not even enter valuation rule. So this agent is not a normal agent, it is a special agent. Now coming back here, in your rule 28, here we have taken the example of related person. It can be even applicable for distinct person, branches. And here you have taken the example of 29. Our focus is to understand optional valuation. The difficulty here is, you are finding it difficult to find assessable value for the supplier in the first case and principal in the next case. But the related person to unrelated person, there is a sale happening. The sale happening is say for 200 rupees. For him, and here also we'll take the same number, 200 rupees. For him, assessable value is not at all a question because it is under section 15. Answer is 200. Assessable value is not at all a question because it is under section 15. Answer is, the difficulty is for the first case where if at all you are having transaction between related person, the valuation is under rule 28. Here the valuation is under rule 29, principal agent. For them there is a problem. They have an option either to go with 3 steps of rule 28 or 2 steps of rule 29, or to go with, now we are trying to understand only option valuation. Optional valuation, what they will do? They will take the next person selling price multiplied by 90%. Optional valuation. The condition for optional valuation is the transaction should be only pertaining to goods. Second, this related person or agent should be only a trader. He should not be a manufacturer. He should supply the goods as such. The supplier or the principal can be anyone. They can be manufacturer or they can be trader. But they are taking their value based on the next person. The next person should be a trader. So there are 2 criteria for your optional valuation. It is applicable only for goods, and the person whose selling price you are taking and multiplied by 90%, he should be a trader. He should be a trader. This optional valuation is applicable only for goods sector. Only for goods sector. And that too is applicable if the next person in chain based on whom you are trying to find your value should always be a trader, because you should supply that item as such. You can be a manufacturer, you can be a trader. So supplier is not a problem. The next person in chain should be a trader. Optional valuation. Optional valuation. When I tell optional valuation, they had an option. In rule 28, they had an option to go through the 3 steps of rule 28, which they ignored and they went for optional valuation. In rule 29, they had the option to go with 2 steps of rule 29, which they ignored and they went for optional valuation. That is that. So these 2 rules have something special called as optional valuation. Now one more special point. Only and only in rule 28, when you see the 3 steps, regular valuation, not optional valuation, regular valuation. Rule 28 has got how many steps? 4 minus second step, 3 steps. In the first step, there is something called as deemed open market value. If the recipient, which is my related person or my distinct person, is eligible for full ITC, then I can give any value that will be treated as deemed open market value. But the condition is my related person or my distinct person should be eligible for full input tax credit, full ITC. Then any value I give will be treated as deemed open market value. This concept is applicable only for rule 28, not applicable for 27, not applicable for rule 29. There is something called as deemed open market value in rule 28. It is not the third valuation. There are only 2. 27, only 1 valuation, 4 steps. 28, 2 valuation. Regular valuation, optional valuation. In regular valuation, first step is open market value. There you have a special point called as deemed open market value. The recipient is eligible for full ITC. 29, 2 valuation. Regular valuation, 2 steps. Optional valuation. There you don't have the concept of deemed open market value. Deemed open market value concept is only for rule 28 related person or distinct person transaction. Are you guys clear with this understanding? That is all and all about your, everything about your 27, 28, 29. 27, only 1 valuation, 4 steps. 28, regular valuation, optional valuation. Regular valuation, 3 steps. First step is having a special thing called as deemed OMV. Deemed OMV. If the recipient is eligible for, that's a condition. If the recipient is eligible for full ITC. And 29, 2 valuation. Regular, 2 steps, optional valuation. Again, there you don't have any concept of deemed OMV. Deemed OMV is not there in 27 and 29, it's there only in 28. Now, once you go through all the steps, if at all you are not able to find the answer, then you are going to go to 30 and 31. Basically, most of the answers you will get in 27, 28, 29. But at times, you will not be finding answer in 27, 28, 29. You have to resort to 30. Classic example is, if at all you are giving gifts of free samples to unrelated person. Gifts of free samples to, is it non-monetary consideration? No, there's no consideration at all. Forget about monetary or non-monetary. So 27 is not covered. Tata Limited is giving gifts of free samples to its customers. Tata Limited has taken ITC. So it has to pay output tax. For valuation for Tata Limited, will it go for 27? No. Because there is no consideration, forget about non-monetary consideration. Will it go for 28? No. Because the transaction is between Tata Limited and unrelated person. Will it go for 29? No. There is no transaction between principal and agent. So what is the rule that it will select? Rule 30. So when you select rule 30, it is 110% of cost. If it is manufacture, 110% of cost of manufacture or production. If you are a trader, 110% of the cost of acquisition. If you are a service provider, 110% of the cost of provision of services. It is 110% of cost. Manufacture means cost of production. Trader means cost of purchase or cost of acquisition. And service provider means cost of service. And what is rule 31? If at all you are not able to even find the answer there, best judgment assess valuation. Reasonable means rough valuation. There's no other option. Best judgment valuation. Always when you talk about service sector, they have a soft corner. What is a soft corner? If at all you are not able to find out cost, forget rule 30, go directly with 31. For a trader and manufacturer, it is rule 30 then 31. For a service provider, you can ignore rule 30, directly apply. For a trader and manufacturer, try rule 30, then go with 31. But for a service provider, ignore rule 30, directly you can go with 31. Directly you can go with. So for a service provider, they tell that you may directly opt for 31. For a trader and manufacturer, they tell that no. First try 30. If not successful, try 31. So that is all about your normal valuation rules. Now moving on to the second part of your valuation rule. Special valuation rules. Special valuation rules focuses only on 31A and 32. 31A only focuses on your actionable claim. 32 different sectors. Special valuation rules will give you direct different formulas. And understand that if you're lucky enough, you'll get 2 valuation questions in your exam paper. One, based on section 15. 27, 28, 29, 30, 31 are never touched, mostly because the moment you see the question itself will have an answer. Question by default, if you remember the steps, question itself will have an answer. They will focus on special valuation rules. 31A and 32, more importantly 32. Right. Now what is 31A and 32? Special valuation rules for special sectors. For actionable claim, they have 31A. For lottery, there is one formula. For betting gambling, which includes horse racing. For betting gambling, betting includes horse racing. That is a special formula. For lottery, what is the formula that they give? What is the value? For lottery, the value is face value of the ticket or price notified by the organizing state in the Gazette, whichever is higher. The face value of the ticket or the price notified by the organizing state, whichever is, but that is not the final answer. Multiplied by 100 divided by 128, simple understanding, come tax calculation. The rate of tax is 28. They know that the amount which is collected from the customer in case of lottery includes GST. Separately, GST will not be collected. So first, what to find out? See, take the face value of the ticket. See the price notified by the organizing state, whichever is higher. Take that answer. That is not the final answer. Multiplied by 100 divided by 128. Now, when you talk about betting, gambling, and horse racing, so you can clearly find out the difference. poor people, rich people. Poor people's time pass of money, rich people's time pass with money. Poor people with an expectation that they'll become richer soon, richer people with an expectation that they will become more richer. Reality, nothing is achieved. Right? Clearly, if at all you try to bifurcate it, clearly you can visibly see that particular point. When you talk about lottery, it's very common for a poor person. Obviously, rich person will also take. I'm not denying that. But what is a normal practice? Out of the savings, they'll try to put something in lottery, expecting that something special will happen, and at one point of time they'll get a big lottery, and which happens in many occasions. But when you talk about betting, gambling, and horse racing, I'm not talking about a person who's having a kind of addiction. If you're addicted, even whether you're rich or poor, will do it. But when you're talking about the normal categorization, betting, gambling, horse racing, it is a game or gamble which is taken by rich persons. There, what is the answer? It is the face value of the bet or the amount paid in totalizer. It's not whichever is higher, because either or it will be there. Either you put your bets in the automated machine, totalizer value, or if at all it is not by an automated machine, manually tickets are issued, then you cannot rely what was the value. Therefore, they go with the face value of the ticket. It is not whichever is higher. It is either or. No income tax calculation. Why? Rich. In addition to it, collect GST. In addition to it, collect GST. For poor person, the final amount which will be collected is the final lottery ticket value. They will not collect GST in addition to it. Therefore, they are required to do income tax calculation. Here, there is no requirement of income tax calculation. You have come here for becoming more rich. Why not pay extra tax? Why not pay extra tax? Pay tax. This is the value. On that you pay tax. That is all about your rule 31A. 31A is over. Lottery on one part, betting, gambling, including horse racing on the second part. Now we are focusing on 32. Different sectors are covered that. Different sectors are covered that. Though there are examples given here, I'll only tell the concept. We are going for a fast track revision, marathon revision. We'll not be seeing the examples. Focus on the concepts that we have already discussed. So only focus on the concepts. First is for money changer. For money changer, basically you're talking about banks and authorized dealers. So when you're talking about money changing banks and authorized dealers, they have two options. Option 1, Rule 32-2A. Option 2, Rule 32-2B. And option 1's exercise cannot be withdrawn during the balance part of the year. So till the year end, you have to be in that option. Till the year end, you have to be in that particular option. Now what is option 1? Option 1 is very normal option. You are trying to find out the margin. Please understand that these money changes, be it bank or authorized dealers, if at all I go to a bank or authorized dealer and if I want say $100 and the dollar value is rupees 80. Dollar value is rupees 80. I end up paying 81. Now understand that the margin of the bank or the authorized dealer is only rupee 1. Rupee 1 per dollar multiplied by $100, 100. That 80 rupees transaction, to put in a simple manner, I have totally paid 8,100 for $100, where the RBI rate was rupees 80 per dollar. In reality, I should have paid only 8,000. How much I ended up paying? 8,100. I can bifurcate this into two. The first portion in mere transaction in money, no GST. The second portion is service charges related to transaction in money. So the first portion will not have any tax. The second portion will have tax. This is only to tell you that service charges are a small portion. Service charges are out of this total transaction which is worth 8,100. The value is only 100. And please mind you, be it normal valuation rule or special valuation rule, we are trying to find out the value, not the GST. So this 100 rupees is not the GST. This 100 rupees happens to be the assessable value. All the rules, not only this rule, all the rules, whatever answers we are trying to find, it is accessible. After that, you will take the rate and find out the GST. If you understand this particular point, what will be the normal case? if one of the currency is Indian rupees and there is the RBI reference rate which is available, the example that you have taken, what you have to do? You have to subtract the RBI rate with the buying rate of the selling rate multiplied by the number of foreign currency. You'll get the answer. You'll get the service charges. In our example, we got 100. What if one of the currencies is Indian rupees but RBI reference rate is not available? We'll take the same example. 8,100 I paid, but RBI reference rate is not that. I don't know what is the range. In this case, I had an RBI reference rate. So what I did, this answer how I got? It is rupees 81 per dollar minus the RBI reference rate 80 per dollar multiplied by number of dollars, and that is the reason I got this 100 rupees. Correct? Correct. This is the other way to calculate it. I got this 100 rupees by taking the buying rate minus the RBI rate multiplied by the number of dollars, the margin. Because I had the benchmark rate to compare my margin. What if I tell that in the same example, in the same 8,100, I took 8,000, I got $100 by paying 8,100, but I now RBI reference rate is not available. I don't have the benchmark. What to do? 1%. 1% is a deemed margin. So take that 1% of gross amount in Indian rupees. In our example, that 1% will be of 8,100, which is 81 rupees, which is 81. That will be the answer. That will be the answer. In the first case, our answer was 100. In the second case, answer will be 81. 8,100 multiplied by 1%. What if both the currencies are foreign currency? What if both the currencies are foreign currency? Dollars for pounds or dollars for yen. What to do? First, convert both of them into Indian rupees by multiplying by the RBI reference rate. Convert that dollar, supposing $100 exchanged for say 120 pounds. Let us forget about the reality rates, just some numbers. So $100 converted into rupees by taking the RBI reference rate. 120 pounds converted into rupees by taking the RBI reference rate for the pounds. You'll get both in rupees. Take 1% of that. 1% of that. Supposing dollars into rupees, you get 81,000. Pounds into rupees, you get 83,000. So 1% of that is 8, 10 and 830. Whichever is. So answer will be 810, not 830. Normally government has got this bad habit of telling whichever is higher. Maybe by negligence here they have said whichever is lower. So their focus is on 810. Convert both the foreign currency into Indian rupees by RBI reference rate multiplied by 1% because margin will be very small, 1%. You will get now two answers. Take whichever is. That will be the final valuation answer. This is, I repeat, this is not GST. This is only accessible value. This is option 1. Option 1. Multiple scenarios possible and answers being given. Option 1, totally how many scenarios are there? Scenario 1, case 1, case 2 and case 3. In option 2, you have only one scenario. You are not discussing about 3 scenarios. You are discussing only and only about one scenario. Where you tell that, forget about everything, whatever you exchange in Indian rupees, focus on that. Whatever you exchange in Indian rupees, focus on that. You would have either paid Indian rupees or you would have either got Indian rupees. Either paid Indian rupees to get foreign currency or got Indian rupees by selling foreign currency. Focus on that Indian currency. Take that Indian currency and apply your income tax slab wise calculation. Here you have to work like your income tax slab. What is that income tax slab? Supposing total amount that you have exchanged in Indian currency is 1 crore 10 lakhs. 1 crore 10 lakhs. What you have to do? For the initial 1 lakh. 1%. For 1 lakh to 10 lakhs, which is next 9 lakhs. It is 0.5%. For the balance 1 crore, 0.1%. What is the answer that you will get? For the first 1%, you will get 1000. Next 4,500. And next you'll get how much? 10,000. Totaling to 15,000. This is your assessable value. You don't have multiple cases. This is only a single case. Unlike your option 1 where you have different cases, different answers. Here there's only one case. You are working like your income tax slab. Right? For the initial 1 lakh, 1%. See, very simple understanding. The more the value, the margin will get decreasing. That's the understanding. 1 lakh to 10 lakh, that is next 9 lakhs, 0.5%. More than 10 lakhs, 0.1% is your margin. Take totally. Check your answer. If at all the answer is lesser than 250, bring the answer as 250. If the answer is lesser than 250, bring the answer as 250. If the answer is more than 60,000, bring the answer as 60,000. The range should be between 250 to 60,000. The lower limit and the upper limit. If you get an answer which is less than 250, bring it to 250. If you get an answer which is more than, here we got an answer which is between 250 and 60,000. If you get an answer which is less than 250, bring the answer to 250. If you get an answer which is more than 60,000, bring it to 60,000. Again. These are all nothing but assessable value, not the tax. Not the tax. That is for your money changer. First option, 3 scenarios. Second option, 1 scenario working like your income tax slab in 3 parts. Now the other special cases. For air travel agent. If at all air travel agent is booking your ticket for domestic travel, domestic bookings, assessable value will be equal to 5% of basic fare. If at all he is booking for international travel, international bookings, assessable value will be 10% of the base fare. This base fare is nothing but the only base fare which will not include other charges. It will not include other charges collected by airlines. It will not include taxes, especially there for airlines. It is only basic fare. Airlines may collect basic fare plus other charges and all. But calculation for air travel agent will be, if it is domestic booking, 5% of the basic fare, the base amount, not extra charges. International booking, 10% of the basic fare, not the extra charges. Mind you, this valuation is for air travel agent, not for the airline company. For the airline company, section 15. Basic fare plus other incidental charges plus other taxes other than GST. As is base fare plus other charges, incidental charges collected by the airline plus travel tax. Because airline will also have travel tax. This will be the value for the airline company. Airline, but we are focusing on what? Air travel agent. 5% of the base fare for domestic bookings, 10% of the base fare for international booking. One was for actionable claim, betting, gambling, lottery, 31A, 32.2 was for money changer, 32.3 is for air travel agent, 32.4 is for your life insurance company. This time it is not for life insurance agent. This time it is for life insurance company. Life insurance company. If at all you have seen the different premium types while doing your audits for your client and all, you will understand how they work. There are various different policies. Policy 1, policy 2, etc. Right? Lots of policies. Highly innovative sector. They will create a new policy based on your requirement nowadays. Right? So when you talk about these policies, that is, the premium contains a risk portion and the savings portion. Please understand that the saving portion is nothing but mere transaction in money, which is not subject to GST. Risk portion will be attracting GST. So premium generally contains risk portion plus savings portion. Savings portion is nothing but mere transaction in money, which is neither goods nor services, no GST. Now, if at all the premium contains only risk portion, then what will happen? Assessable value is the entire premium. Assessable value is the entire premium. But if premium contains risk portion and savings portion, now it contains both. And the savings portion is intimated to the policyholder right in the beginning, that this is the savings portion and this is the risk portion. They'll give you the slabs also. If you read the entire policy documents, they'll be calculating the slabs also. At times you'll be getting the breakup. This is the risk portion, this is the savings portion. In that case, insurance company will pay GST only on the risk portion. Entire premium less savings portion. Less savings portion. But there is one more possibility. The premium is containing risk and savings portion, but savings portion is not intimated to the policyholder. See, the first two scenarios are very simple. Premium contains only risk, entire premium. Premium contains risk plus savings, and savings is clearly set to the policyholder. Then entire premium minus the savings portion, which is again risk portion. Then what is interesting here? It is only when the premium contains both risk and savings portion, but the savings portion is not intimated to the policyholder. The policy document does not specifically talk what is the exact amount of the savings portion. In that case, if it is a single premium annuity policy, one time premium you are going to pay, which is a very bigger amount, and thereafter you are not going to pay any premium. In that case, assessable value is equal to 10% of the entire premium, which means they are trying to tell that risk portion is only 10%. Why? The premium value will be very big, but the risk portion will be only 10%. If it is a normal premium policy that you normally see in your day-to-day affairs, then for the first year, your risk portion is 25% of the entire premium. If it is second year, third year, fourth year premium, then it is 12.5% of the gross premium. If it is single premium annuity policy, risk portion is taken as 10%. If it is yearly premium, first year risk portion is 25. Second, third, fourth, fifth, sixth, the risk portion is 12.5%. 12.5%. Normally, a life insurance company will have all these together. So you have to segregate them, then calculate it. For few policyholder, there will be only risk portion. That is the answer. For few policyholder, there will be risk plus savings, and savings is intimated. Remove savings portion, this portion is the answer. For few policyholder, there will be risk and savings, but savings portion will not be intimated. In that, there will be few premiums which will be single premium annuity policy. For that portion, 10%. Other will be normal category. In normal category, few will be policyholders who have taken the policy for the first year. It is 25%. And few policyholders will be paying premium for the second year, third year. It will be 12.5%. We'll have all these calculations. Now, talking about the next part of the special valuation rule, where the focus is on dealer of second-hand goods. Dealer of second-hand goods. Purchase and sale of second-hand goods. It cannot be applied for a company who is dealing with some other item and it is selling the motor vehicle. You are not the dealer of second-hand goods. You are talking about dealer of second-hand goods. If you are dealer of second-hand goods, you have two options. One, take the ITC on that second-hand goods and pay GST on the normal selling price. Pay GST on the normal selling price. So your assessable value will be equal to transaction value as per section 15. If you want ITC on that second-hand goods. If you are not interested on ITC on that second-hand goods, other ITC you will get. Other ITC will get, but you will not get the ITC of the second-hand goods. Here you will get, in the first scenario, you will get ITC of second-hand goods. Also you will get other ITC. In the second case, you will get ITC of all other items, but not ITC of that item which you are dealing in second hand. Supposing I am dealer of motor vehicles, second hand motor vehicles. I will not get the ITC of second hand motor vehicles. All other ITC of my expenses, be it my audit fees, advertisement expenses, etc., etc. That ITC I will get. That ITC I will get. I may have a premises which is taken on rent, on which there's GST, I'll get that ITC. I may have an auditor who's charging GST, I'll get that ITC. I may do advertisement on which GST is there, I'll get that ITC. I may purchase other capital goods, furniture, etc. I'll get ITC. I'll not get ITC of what? That second hand item. Right. In that case, your assessable value is equal to selling price minus purchase price. Selling price minus purchase price, which is nothing but the margin. You call it as margin scheme. Profit. But here you have to be very careful. All your provisions of valuation till now, whatever we have discussed right from section 15, right from 27, 28, 29, 30, 31, 31A, 32. Please understand it is transaction value. It is different for each transaction. I may have transaction 1, I may have transaction 2. Transaction 1 selling price, purchase price of second hand item is 1 lakh and selling price is 1 lakh 20,000. Transaction 2 purchase price of second hand vehicle, another vehicle is 1 lakh, but the selling price is say 70,000, sold at loss. I cannot club both. I cannot club both. For the first case, assessable value will be equal to 10,000 profit margin. For the second case, assessable value will be equal to 0. The moment I get something in negative, it is 0. It is not minus 30,000. If I am selling at loss, it is not minus 30,000, it is 0. It is 0. That is called as margin scheme. That is called as, I cannot club both. I cannot tell that, okay, net effect 0. No. I have to pay GST on 10,000. Two disadvantages of margin scheme. First, I have to keep a track of the item. When it was purchased, what was the price? When it was sold, what is the price? That tracking is not required in normal case, but it is required in margin scheme. First disadvantage. Second, my margin will be disclosed to the customer. Because when I am going to raise an invoice, my selling price will be 1,10,000, but GST will be only on 10,000. Say 10,000 multiplied by 18%. So that 18% on 10,000 will be 1,800. I am going to charge 1,11,800. This customer will think that price is 1 lakh. Price is 1,10,000 and rate is 18. So he should have charged 18% on 1,10,000, but he is charging only on 10,000. He may be happy at times, telling that okay, by mistake he has charged on lesser amount, happily. And suddenly he may realize when he is having a discussion with his chartered accountant, he may find that this 10,000 is nothing but the margin. And a sad story will be if at all the second hand dealer is his friend and he has said that there is no margin, I am selling for loss. Clearly your margin is disclosed to the customer. Your margin is disclosed to the customer because you are charging GST on the margin. Because you are charging GST on your margin. Are you guys clear with this understanding? Are you guys clear with this understanding? Two disadvantages. One-to-one linkage, margin is disclosed. One-to-one linkage, margin is disclosed. Now there is a special point which is there in case of hire purchase and repossession. How to find out the purchase value? Assume a company DK Limited has purchased the goods, in April 2023 for 1 lakh plus GST. It has given that item, it has given that vehicle on hire purchase. It has given that vehicle on hire purchase somewhere in say June 2023 on hire purchase, installment. Hire purchase, by the way, it is supply of goods. This person is not able to pay the installment. After 3 installment, he is not paying any installment. Therefore, in September 2023, there is repossession of the vehicle. Thereafter, finally, this DK Limited, who was initially the financier, vendor for this hire purchase transaction, now he is reselling that goods. That resale is happening, supposing in the month of say December 2023. Resale. Resale. This resale is now happening for say 80,000 rupees. Don't you think that DK Limited becomes dealer in second-hand goods? Yes. When he has repossessed and reselling, he is nothing but a second-hand dealer. He is nothing but a second-hand dealer. Assuming that he wants to go under margin scheme. In margin scheme, selling price is 80,000. Selling price is 8. Selling price minus purchase price. Selling price is clearly known, 80,000. What about purchase price? Can you take purchase price as 1 lakh? No. Because he became the reseller of second-hand goods only at the time of repossession and resale. When he has purchased initially, that was not a second-hand item. You cannot take that 1 lakh. You cannot take that 1 lakh. So what you have to do? You have to take that 1 lakh as the base, subtracted by 1 lakh multiplied by 5% depreciation for every quarter. Now from which quarter to which quarter? Right from April, first time when it was originally purchased, till December when it is being resold. You may argue technically or logically that it should not be from April to December, it should be technically from April to September because repurchase happened. But they are telling that depreciation will do till the time the goods are sold. So depreciation is from April when it was originally purchased till December when it is finally second time sold. So what is that 5% depreciation? How many quarters are there? From April 2023 till December 2023. How many quarters? In GST, quarters refer to calendar quarters. Even if it is June to December 23, it will be treated as 3 quarters. Even if this was June 23 to October 23, if I change this from June 23 to October 23, if at all I change this, if I change the data and I make it from June 23 to October 23, even then it will be 3 quarters. June will be treated as 1 quarter, July to September 2nd quarter, October another quarter. So whether it is April to December or June to October, it will be treated as 3 quarters, calendar quarters. For entire GST, quarter means calendar quarters. So what will be the answer? How many quarters? 3 quarters. So what is the selling price? Selling price was very clear, 80,000. What is the depreciated purchase price? 1 lakh subtracted by 15%. 85. So margin will be, whenever you get an answer which is negative, your margin will be 0. Your margin will be 0. That is the answer that for second hand goods in case of repossession and resale. In case of repossession and resale. And the last scenario, if at all you're talking about vouchers are being given by companies to the employees or the customers for using those vouchers, then assessable value will be money value of the goods which are redeemable against such vouchers. Which means, which is nothing but the fair value of the face value of the voucher. What you redeem is not allowed. The face value of the voucher will be treated as assessable value. The face value of the voucher will be treated as assessable value. We will be touching this again in your time of supply. Face value will be treated as assessable value. The last scenario, the last case is not relevant because nothing is notified. In your rule 32.7, it talks about certain notified services, but there are no notified services. That being the case, this is not relevant. So when you see a special valuation, how many cases are there? In 31A, it is lottery, betting, gambling, including horse racing. 32, you have money changer, you have air travel agent, you have life insurance company, you have second hand goods dealer, not only for motor vehicles, any second hand goods. Also you have vouchers. You have vouchers. So these are all the cases where you apply special valuation. The last part of this chapter, very simple part of this chapter is clarification. Clarifications. Though it may look lengthy, it's only clarifications. You're talking about your rule 33, 34 and 35. These are only clarification. 33 tells that if at all you're pure agent, you need not pay GST on that value for which you're acting as pure agent. Supposing if I'm charging 1 lakh plus I'm charging 10,000, where I'm collecting the 10,000 as pure agent. I'll be paying GST only on 1 lakh. It does not tell me what is the value. It tells this 10,000 will not be included. If I am acting as pure agent, it will not be included. If this clarification is not there, your incidental expenses will come in picture. And it will tell that add this 10,000 also. This clarification is not there, this incidental expenses will come in picture and it will add this 10,000 also. To make sure that you are not covered by incidental expenses in addition, you have to have a pure agent concept. And pure agent concept, by the way, is a reverse of something that we have discussed in addition. It is payment by supplier to third party on behalf of recipient. Ulta. In your addition, we discussed payment by recipient to third party on behalf of supplier, add it. But payment by supplier to third party on behalf of recipient, if at all you are satisfying the criteria of pure agent, it need not be included in valuation. It need not be included in your valuation provision. That point need not be included in your valuation provision. So it is exactly ulta of one of the addition that we have discussed in your valuation provision. Now first understand that it is to make sure that you are not hit by incidental expenses. Second, understand what is the concept of pure agent. It is nothing but payment by supplier to third party on behalf of recipient. Right, you are collecting this as out of pocket expenses. Reimbursement. Out of pocket expenses. Actual reimbursement. It's not any incidental charges. Actual reimbursement. I was not required to do something. I did it on behalf of recipient. Now I'm getting the reimbursement. I'm an interior decorator. My charges were 1 lakh rupees. My customer said me that even purchase these electrical fittings. So I purchased these electrical fittings on behalf of the recipient. I had nothing to do with it. Now when I'm collecting the amount from my customer, I'll collect 1 lakh plus reimbursement for electrical fittings. But GST will be only on 1 lakh. Now what is meant by pure agent? Pure agent means you're talking about an agent. Without profit margin. So pure agent, you can bifurcate it as agent without profit margin. This is agent. This is without profit margin. What is meant by agent? Supplier is acting as agent of the recipient. He is doing something on behalf of recipient. Agent means there's an agreement entered by supplier and recipient, and supplier is telling that okay, I'll do something on your behalf, but it is finally your responsibility. So if interior decorator is purchasing electrical fittings, it is on behalf of recipient. First condition is agreement. Second, whether the interior decorator will get the title to the electrical fittings? No. Interior decorator will not get the title to the electrical fittings. The ownership will be directly to the customer, recipient. Whether interior decorator will use these electrical fittings? No. Interior decorator will not use these electrical fittings. This will be used finally by the recipient. Whether interior decorator will have any margin on the electrical fittings? No. He'll only collect the actual amount incurred by him. Rather, you'll find that along with this invoice, the interior decorator has to give the invoice of the electrical shop. When I tell he is not getting the title, the electrical shop owner will write the name of the customer as interior decorator or the recipient of interior decorator. Right. Agreement entered by the supplier with the recipient to act as agent. Supplier does not get the title. Supplier does not use the goods or services. Supplier does not have any profit margin on that 10,000 rupees, which is actual reimbursement. This is the definition of pure agent. In addition to you being acting as pure agent, you have to make sure that you split up your pricing. You split up your invoice. 1 lakh is your charges, 10,000 is reimbursement. 10,000 is reimbursement. This is repetition. You should be acting as pure agent. Secondly, you should go for split up pricing system. Thirdly, you make sure that the extra work that you're doing, that extra 10,000 you're charging, is an additional work, not part of your work. It is an additional work, not part of your work. Purchasing electrical fittings was not part of your work. It is an additional work. Chartered accountant paying ROC fees, stamp duty at the time of incorporation is not part of the work. It is an additional work. But chartered accountant charging traveling charges and food charges in his invoice, audit fees plus travel and accommodation is part of your work. Which means if I have to do internal audit, I have to go there, travel, I have to stay there, accommodation, I have to have food charges. There I cannot act as pure agent because it is part of my work. It is my inward supply to do my outward work. It should be an extra work. It should be an extra work. Traveling charges, accommodation charges, that cannot be taken as pure agent. Why? So why traveling charges, accommodation charges you are segregating from that? Because for an auditor to do an internal audit, it is an inward supply. I have to travel, I have to go there, I have to stay there, and I have to do the work. So it is not any extra work. Without going there, without saying that, I cannot complete the work. But if you take the other examples, I could have said no for electrical fittings. I could have said that directly make the payment. I could have said no for ROC fees, stamp duty. I could have said client directly make the payment. But when you're talking about internal audit, for me to do that assignment, I need to travel there. I need to stay there. I need to have the food. That cannot be called as pure agent. That cannot be called as pure agent. One of the repeatedly asked question by ICA is customs charges. Customs broker charging his fees, that will be included in his value. Customs broker will do a lot of extra thing. He'll pay customs duty on behalf of importer, pure agent. He'll pay transportation charges, dock fees, port fees on behalf of importer, pure agent. He'll, along with his invoice, he'll give traveling charges and accommodation charges. That is not pure agent. Customs broker will pay GST on his service charges plus traveling charges and accommodation charges. They are all incidental expenses. There he cannot take the benefit of pure agent. He cannot take the benefit of pure agent. Are you guys clear with this understanding? That's the entire concept of your pure agent. Entire concept of your pure agent. That's one very interesting circular with respect to pure agent. When you talk about your airline companies, Airport Authority of India and the customer. Airport Authority of India needs to collect passenger service fees and user development fees from the customers. They tell that this passenger service fees is to make sure that they are giving services to the passengers. User development fees is to make sure that that airport improvises and there is a development. All nonsense. They are taking extra amount. They are taking extra amount. Who's collecting that extra amount? Airport Authority of India. But if you have ever traveled by airline, you don't have any contact with Airport Authority of India. What they do? They tell airline companies to do it. They tell airline companies, when they are booking the tickets, collect our charges also. Collect our charges also. Passenger service fees and user development fees. Think and answer. What will be the value for Airport Authority of India and what will be the value for airline company? Airline company. There is a customer there. This airline company will collect fare charges, travel taxes. So fare charges 1 lakh rupees, travel taxes 10,000 rupees. In addition to it, it will collect your passenger service fees plus User development fee, say 5,000. And finally, it will charge GST. Customer does not have any direct contact. No direct contact. Obviously, there's a supply provided by Airport Authority, but there's no direct contact. There's no direct contact. This entire amount will be paid to the airline company. What is the assessable value for the airline company? Assessable value for the airline company is 1,10,000. This 5,000, it is acting as your agent. What is the assessable value for Airport Authority of India? Assessable value for Airport Authority of India is 5,000. Right. The amount that 5,000, if at all anyone wants to take the credit, it's only the customer. If customer is giving his GST details by selecting business travel and giving his GST details, he'll get the credit both of 1,10,000 plus GST, also of 5,000 plus GST. He'll have two invoices. He may not directly get an invoice from Airport Authority of India, but it may reflect in your GSTR 2B. It may reflect in your GSTR 2B. Are you clear with this understanding? What is the entire focus here? Airline company, to the extent of 5,000 rupees, it is acting as your agent. It said, I have got nothing to do with this. I am collecting on behalf of someone else. So I have got nothing to do with this. That is the circular. Now, that is all about your Rule 33, Rule 34 and Rule 35. Again, clarifications. 33 was a clarification, 34 and 35 is also clarification. What is Rule 34 telling? If at all you get an amount which is a foreign currency, you have to convert that into Indian rupees. Yes or no? You have to convert that into Indian rupees. Now, what to do? When you're converting that into Indian rupees, first you have to find out time of supply. Step number 1 is time of supply. Step number 2 is exchange rate. Step number 1 is time of supply. First, select the date. First, go with the date. First date, then rate. First date, then rate. D comes before R. So, first date, then rate. First, find out the time of supply. Then select the exchange rate. This will come only if at all the amount involved is foreign currency, correct? The amount involved is Indian rupees. There is no use of Rule 34. That is $1 lakh. You have to convert that $1 lakh into Indian rupees. So first find out the time of supply. First find out the, when I tell first date, it means first find out the time of supply. For goods, section 12. For services, section 30. Then find out the exchange rate. Then find out the exchange rate. For goods, on that date, go with CBIC exchange rate. Not RBI rate, exchange rate, not FedI exchange rate. Go with CBI exchange rate. For services, go with gap exchange rate. Depending on whether you have to go with your Ind AS or AS, depends on what category of company you are. So go with your gap rates. Go with your gap rates. Generally accepted accounting principles. It might be your Ind AS, it might be AS, it might neither of them. For small categories, it might be none of them. You can apply as per your normal accounting principles or normal understanding that you have. Correct. So when you start with your accounting, you start with when Ind AS is applicable, when AS is applicable at certain times, when selected AS are applicable. For SMEs, there is only selected AS, not all AS. Selected AS are applicable. So it depends. That being the case, they have simplified it. Go with gap. Generally accepted accounting principles. For goods, go with CBAC rate. For services, go with gap rate. But for both, first find out the date. So first, there will be multiple dates. First, freeze the date. Same time of supply. On that date, if it is goods, only see CBAC exchange rate. Don't see RBI, don't see FedI. If it is service, only see gap exchange rate. That is Rule 34 for you, converting foreign currency into Indian rupees. And what is Rule 35? Come tax calculation. If at all amount is including GST, then how to find out the value? How to find out the tax? It is value multiplied by tax rate divided by 100 plus tax rate. How to find out the value? If at all I am required to find out the value, assessable value will be equal to value inclusive of taxes multiplied by 100 divided by 100 plus rate of tax. If at all Objective is to find out the value. Numerator is 100. If the objective is to find out the tax, numerator is tax rate. Come tax calculation. Come tax. This rate of tax is the correct rate of tax. Correct rate of tax. If you thought it is 5%, finally if you find it is 18, in this formula you're going to take 18%. In this formula you're going to take 18%. Right? When you're going to calculate this formula, if you've gone with wrong rate, 5%, finally you find that it is 18. So say 100 plus 5, but finally you find it is 18. So when you're trying to calculate this answer, you'll go with 105. Though you have gone with wrong rate, you have collected something from the customer. Whether right or wrong, it is 105 final amount received from the customer. Multiplied by 100 divided by 100 plus 80. This will give an answer. This is the final tax. If you take this number, what will be the answer? 105 multiplied by 100 divided by 100 plus 80. It will be, okay, I am going to take the tax. I need to find out the tax, final tax. So I'll take the numerator as 18. If I want to find out the tax, I'll take the numerator as 18. Then 16 point. So rounding off to nearest rupee 1, 16 rupees. What is the differential tax that you will end up paying? 16 rupees that you have to pay, and already you have paid 5 rupees. Though it was wrong, already you have paid. So what is the differential tax? So final tax is 16. Differential tax is the correct tax minus the tax that is already paid. Right. What did I say the question? In the question I said, you wrongly collected 5% GST. So you collected 105. Finally you found out the rate is 18. What to do now? Whatever you have collected, whether right or wrong, take that as the base. Multiplied by the rate of tax if you want to find out the tax, divided by 100 plus the rate of tax. What rate of tax? Correct rate of tax. You will get the final tax. This final tax is 16. But out of the 16, you have already paid 5. Assuming that you have collected and paid to the government. So differential tax that you have to pay now is 11. That is rule 35 for you. So when you see all these points, you're done with your valuation provision. So how we discuss the valuation provision? Basically into 4 parts. 1, normal valuation section 15. Then valuation rules in 3 parts. Normal valuation rules 27 to 31. Special valuation rules 31A, 32. Clarification 33, 34 and 35.